Okay, so let's understand now about forward market. In foreign exchange market, how forward markets terminologies are there, what are the concepts involved here, and how do we calculate. So we have to understand like premium discount, swap points, the concept of appreciation depreciation, hedging using concept of forward rates, and also forward contract settlements. We are like overdue contract, early delivery, cancellation, like that. Okay. So what is the basic meaning of forward rates? Let's just write the meaning of it. Forward contracts. It is the contract entered today. It is the contracts entered today for settlement at a predetermined date. Predetermined date and at predetermined rate. Predetermined rates. Okay, the predetermined date is called as due date. The predetermined date what we have, this is called as due date. The date on which the contract is supposed to be executed. Due date. And predetermined rate means it's called as the forward rate. Forward rate. And this so forward rate is for a settlement at a later date. If it's for immediate date settlement, what do we call? Spot rate. And spot rate does not require any forward contract. Spot rate happens immediately. So we will have some difference between these two. Let's understand what do we call those terms and what are the relationship that we can calculate. Now forward rates can be quoted. Forward rate, it can be quoted more than spot rate. If it is more than spot rate, then we call that as premium. If forward rate is less than spot rate, it is called as discount. It is called as discount. So forward rate is 61 rupees, spot rate 60 rupees. For today's settlement, 60. If you want 1 month later, 61. So that is said to be at premium. If today rate 60, forward rate 55, expected to be below spot rate, that is called as discount. It can also be expressed in percentage. So premium or discounts percentage. If it is negative, it is discounts. Formula will be like P1 minus P0, like that. Forward rate, FR means forward rate, minus SR means spot rate, divided by spot rates into hundreds. And to express it in annual terms, we will do into 12 divided by number of months. So this will express in percentage terms. If positive means premium, and if it is negative, that means it is discount. And forward contracts are not future contracts. They are not traded. They are over the counter contracts. In the sense, they are made between two people, like the person and the dealer, customer and the dealer, dealer and the market, and so on. It's between two peoples. It's a contract signed, so to be settled on a particular date. It has to be honored. Sir, can I cancel it? We have separate discussion. If you want to cancel, if you want to extend, if you want to premature, early delivery, we have separate discussion. We can have it later. Okay. So hope you got these basic concepts of forward market. Sometimes we also say depreciation, appreciation. Currency depreciated, currency appreciated. So depreciated means the currency is at a premium. Appreciated means currency is at a premium. Depreciated means currency discount. But only difference is when we say premium, it's always per annum, usually, mostly. But currency depreciation means we just talk about increase, decrease. We never express it in annual terms basis. Let's understand that aspect. Appreciation, depreciation. Okay, sorry. Before that, I think two more other factors to be understood. Then I'll go for currency depreciation, appreciation. For the time being, let me explain the other part now. Sometimes the quotation of forward contract will be expressed through swap points. Let me understand that. Let me explain you that. Quotation of forward contract or forward rates through swap points. Swap points. For example, they give you like this. Spot rates is like 61.5 hyphen 66, or let's say 61.50 hyphen 66.75, and they give you swap points as, let's say, 20/30. You know how we are going to add? How we are going to get forward rates is calculated by spot rates plus or minus swap points. Plus or minus swap points. Okay, now the question is, when do we add swap points? When do we subtract swap points? So if the swap points are increasing in order, ascending order, if the swap points are ascending order, then they are added. That means they are trading at premium. That's why. If it is descending order, downwards, then it is subtracted. Discount. Now in this example, what do we have? 20/30 ascending order. So forward rate is going to be calculated by 61.50 plus 0.2, 66.75 plus 0.3. 20/30 means 0.2, 0.3. So you get 66.70 and 67.05. So swap points are added if they are ascending in order to get the forward rate. They are subtracted if they are in descending order to get the forward rate. Any doubts on this one? Oh, 61, correct. 61 and 66, correct. 61. 61.7. Yes. $66.75 plus 30. That means 67. No, you get 61. You get. Descending order means 30/20. Correct. Descending order means 60/30. Previous slide I've took it out. It's not there. I just wrote only one formula, right? Forward rate minus spot rate divided by spot rate into 100 into 12 by M. Premium percentage, discount percentage. Only one formula I've written. That's like P1 minus P0 by P0 into 100. Forward rate minus spot rate divided by spot rate into 100 will give you the formula for premium. If it is negative, discount. Okay. Hope you got this one. Okay. Now, one more example I'll give you. Try to think. Suppose spot rate is given to be 66.10, 10, let's say 35 hyphen 66.2025. And swap points are like this. Swap points are 300, 400 slash 400. Now, ascending order, increasing order means we have to add. How much we are going to add? 300 means how much? 300 means how much? Okay, here is one small interesting point. You should always read from right to left. In the sense, we have 20, so last two digits we added 0.20. I mean, here we added 0.20 and here we added 0.30. Similarly, 300 and 400, you know what we should do? Take it for last three digits. So here it becomes 300 if I add 66.1335. And here 66.2425. That 300 add to the last three digits. So 035 becomes 335. And 025 becomes 425. Hope you're able to get the point. The swap points to be added from right to left, Urdu style. Right to left for the last digits. If two decimals are there, last two decimals. Three decimals are there, last three decimals. So swap point should be added or subtracted. Swap points to be added, subtracted. You can write down here itself. Added or subtracted for last few digits. Last few digits means if the swap points are 20, 30, 2 points, last two digits. Swap points are 3, last three digits. Swap points are 4, last four digits. So whatever the swap points are given, you should add to the last few digits depending on the swap points. Is that clear? Okay. I'll take this part out. Later, don't tell me come back to the previous slide. I will be taking out this. Okay, I'll go further. Let's understand some positions in foreign exchange. Then I'll go to the currency appreciation. Positions in foreign forward markets. Let me think from the point of view of an exporter. Now, exporter, what is going to do? He will have his customer in US something, and he is going to sell goods, and he will receive, let's say, US dollars. And the exporter has to sell it in the currency market. Let's say to the dealer or banker. Bank or dealer. Okay, since exporter has to sell USD, what forward contract is he going to enter into? Exporter with the bank or with the dealer, what contract will he enter into? Will he go for the forward sale contract, or will he go for forward buy contract where the quantity is in dollar terms? What do you think? The exporter has to enter into a transaction with the dealer or the banker, because he will have USD, he has to encash it into rupees maybe later. So will he enter into forward sale contract or forward buy contracts? Tell me from exporter point of view. You can see the arrow going out, right? So for exporter, it's going to be forward sell contracts. The exporter will have to sell the dollars, so he will have to enter into a forward sale contract. But for the same thing, from a banker, dollars coming in, so it is going to be forward buy contract. And the rate at which the banker gives, that is going to be called as forward rate. Forward rate. Now similarly, if banker once he receives the dollar, what he has to do? He can't keep it with himself. He can do the business, but just by holding he will not get any money. How does he make money? What should he do? Once the banker receives the dollar from the customer, what he has to do? He has to get rid of it. He has to sell. He sell in the market USD. He sells in the interbank market. Sell in the interbank market. That means he has to do a sale. But he will not sell it today itself, because only when customer gives it to him, then only he can sell. But he will not wait for that day also. So what does bank do? They enter into a forward sale transaction. Forward sale transaction. You know what is this called as? What is transaction is called as? Banker or the dealer, he has a transaction with the customer, with the exporter. Now he has to take one more position to fulfill the obligation to the customer. Once he receives the dollar from the customer, he has to get rid of it, and he has to be protected in advance. Because he gets the forward buy later dollars, he will enter into forward sale contract. He is protecting his position, and that is called as cover transaction. This forward sale, the entered by the bank or the dealer in the interbank market, this is called as the cover transaction. Cover transaction. And you will receive one rate from him, from the interbank market. One rate you receive, the rate what you have. But with the customer, the rate was forward rate, and with the interbank, that rate is called as cover rate. So if they ask for the banker to find out the profit or loss, the difference between the forward buy with the customer and forward sell with the interbank market, that is cover rate, cover transaction, difference between those two will be profit or loss for the banker. This is for the exporter transactions. Let's understand similarly for importer transaction how it happens. But before that, any doubt with respect to exporter transaction, mainly from the banker dealer point of view? With the customer, you will have a forward buy contract, forward rate. Correspondingly, you will have a transaction with the interbank market, which is forward sell rate, one forward buy, one forward sell, so that your position is protected, one buy, one sell. You are buying and selling, nothing is open. And the transaction with the customer is called as the forward rate. The transaction with the interbank market cover transaction is called as the cover rate. The difference between the forward rate and the cover rate is the profit or loss for the banker. That is not coming today, that is known today, but not coming today. That will come only on the due date after the contract period, where both gets executed. So what if one of them not executed? We'll discuss later. Cancellation, extension, or early delivery, we'll discuss it later. I hope you are clear with respect to this thing. Now let me do the import transaction. Similarly, importer will have to make a payment of USD to the supplier, because he will give you the goods and you have to give him the US dollars. And an importer, where does he get the USD? He will get it from the banker or dealer. And where does bank get it from? USD. They will get it from interbank market. Or from another dealer. So what is the transaction that importer does with the bank? Is forward buy. And what transaction with bank do with the customer is forward sell. And for that purpose, they have to buy from the market, and therefore they have to enter into one more transaction with the market, forward buy. And what do you call that forward buy? As covering your position. So that is covering transaction, cover transaction. Cover transaction. And the rate at which is settled between the customer, importer and bank, this is called as the forward rate. And the rate at which the bank will have to pay to the interbank, this is called as the cover rate. And difference between the forward rate and the cover rate is the profit or loss for the banker. Okay. One more small concept we'll discuss. After that, we can go for problems. Any doubts on this one? One of you are asking question regarding interest rate. We'll come to it. We have an interest rate parity theorem. There we discuss what is the impact of interest rate on these things we discuss. Okay, let me just do one more small concept. I'll take this chart out. Hope it is done. Okay. One small concept, currency appreciation and depreciation. Okay. For example, if I say 1 USD is rupees 70 and US dollar appreciates by 10%. Now, here please tell me 10% USD appreciate means where should I add 10%? For the 1 USD I should add, or 70 rupees I should add? Where 10% to be added? To the left hand side to be added or the right hand side to be added? To get the new rate. USD appreciate by 10%. So left hand side to be added or right hand side should be added? It is right hand side, rupees, not USD. USD appreciate means USD price is appreciating, not USD. See, if you have 1 liter petrol is equal to, if they say 70 rupees and they say petrol appreciated. If they tell you petrol appreciated, does it mean you get more petrol? Petrol appreciate means petrol price is appreciated. Similarly, USD appreciated means USD price, which is rupees appreciated. So, instead of understanding so much, when left hand side appreciates, apply the percentage on right hand side. If right hand side appreciates, apply the percentage on left hand side. So basically, whichever currency appreciate, apply the percentage on other sides, not that itself. So if USD appreciate, don't apply it on USD. The rupee is getting appreciated. Its price, petrol price getting appreciated. USD price getting appreciated. Similarly, depreciation. That is appreciation we do plus, depreciation we do minus. Let me take one simple example to understand that. Numericals. Suppose if you have 1 USD equals rupees 50 and we are having, let's say, USD appreciates by 10%. Then what do? 1 USD equals rupees 50 plus 5 on 50, 10%. So it becomes rupees 55. Dollars getting more priced, more costlier. So we can say dollar is appreciated. It's getting increased by 10%. Now, let's say other way around. If US dollar depreciate by 10%, means how do we calculate? 1 USD equals rupees 50 minus 5. That is 45. Dollar depreciated means it becoming more cheaper to be 45. Now let's understand. USD appreciated 10%. Does it mean INR depreciate by 10%? That's an interesting point. If one currency appreciates, other currency depreciate, is it true? Yes, it is true. One currency appreciating means automatically other currency depreciating. Against rupee dollar, if dollar is going up, obviously rupee is down only, no, on comparison. So when I say dollar appreciates, rupee is depreciate. But is it exactly amount? It's not the case, but it is approximate. It is approximate. Let's see how it happens. 1 US dollar, I'll make it as 1 rupee equals to, because I need rupee price. So 1 INR equals to 1 by 50, that is 0.02 USD. Now INR depreciated by 10%, so I should apply it on right hand side. So it becomes what? 0.02 minus 10% means what? Minus 0.002, and that leaves how much? 0.018. 0.018. That is 1 INR equals to. Okay. Approximately now, what is 1 USD equals to? Express back. 1 USD equals to, like a reciprocal of this, 1 by 1.018, you get 55.55. You can see earlier we got 55, now we got 55.55. So USD appreciate by 10%. Does it mean INR depreciate? True. Does it equally depreciate? Not true, but approximately true. So if US dollar appreciates by 10%, rupee depreciates by 10% approximately, but not accurately because of mathematical reasons. Logically true. In some examples I've seen, they have taken other way around also. That's also fine. From exam point of view, you can say dollar depreciate by 10% and approximately depreciate by 10%. That's okay. You can take it. Mathematically, it's not 100%, but it's almost, you can see. So people in practical life use it interchangeably. Mathematically it's not right. It's like a multiplicative model, additive model. First year 10%, second year 10%, total 20%. Logically correct. Mathematically not correct, because on 10% also you get one more 10. So it becomes 21%. The difference between additive model, multiplicative model we discussed. So when we discuss, when people talk, when they communicate, they use this interchangeably. Depreciates by 10%, appreciate by 10%. Completely fine. But be aware, mathematically it's not 100% correct. How to approach an exam? Both are accepted, but whichever you write a note that US dollar appreciated by 10% and rupees depreciated by 10% approximately, which has been applied. So whatever assumption you write, make a clear in writing in the examinations. You'll be very, very clear with respect to the value added is concerned. So INR depreciate means US dollar depreciates, approximately correct, not accurately because of mathematical reason like multiplicative model. But in practical life, they use interchangeably. In exam also, you can use interchangeably, but by giving a proper note. Sometimes institute solution, without note also they solve, because that's how they communicate practically, but that's fine. Let's see for other case also, the same thing applies. US dollar depreciate by 10%, does it mean INR appreciates by 10%? As per this logic, you should get an approximate answer. Let's see what we get or not. So one INR is 0.02 appreciates. So you get 0.02 plus 0.002. That will give you 0.022. So what is 1 USD equals to, then take a reciprocal of this, 1 by 1.022. 1 by 0.022. 45.45. See, you get the approximate same answer, 45. Approximately it's fine. So while solving the problem, what I would recommend, if LHS appreciate, percentage on RHS. So on 50, you add 10%, you get 55. You got the answer. If RHS appreciates, rupee appreciating by 10%, add it to the left side, which means $1, you add 10%, it becomes 1.1. 50 by 1.1, you get 45.55 and 45.45. So, say rule is simple. If LHS appreciates, apply on the right hand side. If RHS appreciates, apply on the left hand side. Appreciates you do plus, depreciates you do minus. So whichever side appreciates or depreciates, other currency to be changed. That's all you have to remember. Are you clear on this one? One more small theoretical point I would like to add, relevant for currency depreciation only. I hope it's fine. Okay. Okay. So impact of currency movements. Impact of currency movements. Local currency appreciates, which means, understand, foreign currency depreciates. Not equally, but definitely same direction. But they use interchangeably, that's also fine. Foreign currency depreciates. Similarly, local currency depreciates, foreign currency appreciates. Okay, let's understand what will happen to the position of importer and what will happen to the position of exporter who has a receivable. Similarly, I mean receivable, payable, outstanding. In this case, importer position and exporter position. Okay, now tell me, when local currency appreciates, importer will have a profit or loss. I'll tell you simple technique. Think from a balance sheet point of view. Importer has got balance sheet liability because he has to make the payment. Liability in which currency he has? Liability in foreign currency, right? He has to pay in foreign currency. Liability in foreign currency. If you have a liability in foreign currency that depreciates, it's going to be profit. Think from balance sheet, very simple. Has a liability in foreign currency. Liability in foreign currency, now that reduces, depreciates. Good, profit. What about exporter? He has an asset in foreign currency. His receivable, dollars, asset in foreign currency. And foreign currency depreciate, asset depreciating is going to be loss. It's going to be loss. See, this is all important even from your FR point of view, because you have an impairment of asset. What if you have fixed asset situated outside India? The asset value will depreciate. Because of exchange rate also it can depreciate. So impairment will come. Plant property impairment Ind AS 36 will come. Plant property equipment Ind AS 16 will come. Exchange rate Ind AS 21 will come. And you go somewhere. So all these concepts, if you learn properly, you can apply in FR, especially like impairment concepts. Anyway, so coming back, importer, local currency depreciates, foreign currency appreciates. Importer has got a liability in foreign currency, and that foreign currency appreciating, you have to pay more, so it's going to be a loss. For exporter, has got asset in foreign currency, and when the foreign currency appreciates, asset depreciates, is going to get profit. There's the impact of profit or loss to understand the concepts. In problems, one a small area it might come. I'm just giving you as a hint. Okay, let's go further. Next one, given the following rate, spot rate, 3-month swap points, find the forward rates and premium or discounts. Okay, now look at the swap points. Swap points are increasing order, ascending order, increasing order. Therefore, the swap points need to be added. Swap points are added. How do we calculate the forward rate? It is spot rate plus swap points respectively. So 24 for the first one. Again, last 2 digits I told you. So 45.01 plus 0.24. You get 45.25 and second one 45.12 plus 0.36. So you get 45.48. This is the forward rate. Then the premium formula works: forward rate minus spot rate divided by forward rate into 100 into 12 by number of months. Let's do for bid rate. Then let's do for offer rate. For bid rate, it is forward rate, first one 45.25 minus 45.01 divided by 45.01 into 100 into 12 by number of months. Second rate 45.48 minus 45.12 divided by 45.01 into 100 into 12 by number of months. Number of months is 3 months. We can divide by 3 each. Hope you get 2.13 and 3.19. I think 3.20. Okay, 3.20. Okay, let's go further. Okay, so next one. Excel exporters are holding an export bill in United States dollars 1 lakh due 60-day hence. They are worried about falling USD value, which is currently at 45.6. The concerned export assignment has been priced on an exchange rate of 45.5. The firm's bankers have quoted a 60-day forward rate of 45.20. Calculate the rate of discount quoted by bank, the probable loss of operating profit if the forward sale is agreed. Okay, very good. Rate of discount. Discount or premium formula, you know. Forward rate minus spot rate divided by spot rate into 100 into 12 divided by number of months, or you can do number of days. So forward rate given 45.20. Spot rate currently trading at 45.60. Divided by spot rate 45.6 into 100 into, you can do number of months or you can do number of days. Since they said number of days 60 days, let's keep it as number of days 60 days. That is, instead of 12 by m, I'll make 365 by number of days. So 365 by number of days 60. You can also assume 1 year equal to 360 days, and you can do 360 days. 360 by 60, that is also accepted. So that comes to 5.33 minus 5.33 or minus 5.44%, minus 5.33 or 34. You can round it off to 34%. Then probable loss if forward sale is agreed. If forward sale is agreed. This is more like an accounting profit. The concerned export consignment has been priced on exchange rate of 45.5. So what is current receivable as per books? Currently receivable is for every dollar 45.5. You have already priced it 45.5. But if you enter into forward contract, a forward sale rate is applicable. Forward rate that is realizable, receivable. Forward rate receipt that's going to be received will be 45.20. So you booked at 45.5, but you're going to receive 45.20. So probable loss is 45.20 minus 45.5. You booked at 45.5, but you receive only 45.2 multiplied by number of units, 1 lakh USD. When you multiply by USD, resulting is in numbers. So rupees 35,000. 30,000. Okay, 30,000 rupees loss, 30,000. Negative you come, that means loss. Loss 30,000. Okay, let's go further. Okay, so let's do this problem now. On April 3rd, a bank quotes the following. Come to that problem. On April 3rd, a bank quotes the following. Hope you got the question. Spot exchange rates. Two rates, two rates, correct. One for bid and offer. 2 month swap points, 3 month swap points. See, swap points are increasing 70, 90 and 160, 186. Increasing means they are ascending order. So they are at premium. So they need to be added. In a spot transaction, delivery is made after 2 days. Assume one swap point is 0.0001. So that gives us the clarity. That's what we always used to do. Take last digits, not necessarily last 2 digits. Last digits. 70, 90, I'll add it to last 2 digits. But 160, 186, I'll add it to last 3 digits. Last, right from the left. Right to the left. And one more important point. They said April 3rd and delivery is made after only 2 days. Effectively, these rates are applicable for April 5th. Because effectively it comes to you only on April 5th. So effective date is April 5th. You're required to Ascertain the swap points for 2 months and 15 days. Please observe, 2 months and 15 days means F from effective date. Effective date is April 5th. 2 months later, May, June. And 15 days more. So June 20th. That's they only have given, but for clarity's sake. From April 5th, 1 month, 2 month, June, May, June, and 15 days, it becomes 20th June. Determine the foreign exchange rate for 30th June. Compute the annual rate of premium or discount on average rate. Okay, that's all we have to calculate. Okay, first swap points. So what they've given, let's write down. So for 2 months and for 3 months. 2 months swap points are given. 3 months swap points are given. 2 months swap points are 70, 90. 3 months swap points 160, 186. And they're asking for 2 months, 15 days. They're asking for 2 months, 15 days. Are you able to understand what method they're asking you to do it here? Interpolation method. For 2 months we have, for 3 months we have, in between those two, for 2 months, 15 days, we need to do it. Interpolation method. So 2 months to 3 months. What is the gap? 1 month means 30 days. And 70 to 160. What is the gap? 90. So for 30 days, we are getting 90 points. But we don't require for 30 days. We require only for 15 days. For 15 days, how many points? In between, interpolation. And don't do simple calculation. 2 months 70 means how much for 15 days? That will not work out. We are trying to interpolate between 2 months and 3 months. So cross multiply. 15 into 90 divided by 30. $45. So for 2 months it is 70. For 15 days it is 45. So swap points for 2 months, 15 days. Is 70 points plus 45 points, 115. Similarly, other one, so you get 90 to 186 means 86 points, I think, or 96 points. So for 30 days, it is 96 points. We require only for 15 days. How much? Cross multiply. 15 into 96 divided by 30. We get 48, I think. So swap points for 2 months, 15 days becomes 90 points plus 48. That is 138. So 115 and 138. Okay, so first part of the question is done. Second, determine the foreign exchange rates. Foreign exchange rate as on June 20th, which means we are going to do April 5th spot rates plus swap points for 2 months 15 days. April 5th spot rate, that is 66.2525, 67.95945. Add the swap points we just calculated. 115. 115 means last 3 digits. So it will be 0.0115. And 138 last 3 digits 0.0138. The bid rate, offer rate. Six point 264, 67.608. Okay. Then third one. What is the annual rate of premium or discount? Annual premium or discount. If positive comes premium, obviously positive only will come because it's premium. Swap parts are also increasing. But if negative would have come, it would have been discount. Formula once. Premium formula. Forward rate minus spot rate divided by. Can you tell me what it is? Divided by what will we do? Into 100 is fine. Into 360 by number of days or number of months, both are fine. But divide by what? Normally we used to do divide by spot rate. But in this problem, please read. Compute the annual rate of USD on INR on an average rates. So denominator is not spot rate. Denominator is average rates. Average rates. Average means spot plus forward divide by 2. So when they give you the question like that, we use average rate. So for the bid premium, forward rate 66.2640 minus 66.2525 divided by not 66.2525 average 66.2640 plus 66.2525 whole divided by 2 on an average rate multiplied by 100 into 12 by 2 months 15 days, let's say 2.5 months, so you can do 2.5. Similarly for offer, $67.6083 minus spot rate 67.5945 whole divided by average 67.6083 plus 66. 5945 divided by 2 into 100 into 12 by 2.5. Actually, average order rate is also logical. If you remember YTM, bond valuation, long time back, coupon plus redemption price minus market price divided by N, whole divided by market price plus redemption price divided by 2. We used to take average investment. So that's also logical. But in the exam, unless they ask, we don't do it. We don't recommend that. Standard one is just divide by spot rate. In this question, they said average rate. We are using average rate. So how much we get? See if you get 0.083% and 0.098%. Okay, let's go further. Okay, so now let's understand two important theories which are very much relevant conceptually, and while solving problems also is going to be very, very important, and practically also, if you can apply, this is very relevant. Two theorems are there. First one, purchasing power parity theorem. Purchasing power parity theorem. What does this say? This says law of one price. Law of one price. That means in two different countries, currency may be different, but their ability to purchase should be same. Purchasing power means ability to purchase. Just to give you an idea. People have this one, pound is more stronger, dollar is more stronger, they're higher priced, but value may not be high. I'll give you an idea how it works. You have always seen $1 equal to so much of rupees, £1 equal to so much of rupees. Have you come across any time where 1 rupee equal to so much of other currency? Have you seen? Many Asian countries are there. One of them, one of the example I give you is Indonesia, where 1 Indian rupee is 200 Indonesian rupee. 1 Indian rupee is 200 Indonesian rupee. So I was traveling there. So just imagine I was traveling with 1 lakh with me, and 1 lakh into 200. I was just carrying 1 lakh for the travel and 200. So how much is going to be? 1 lakh into 200, 2 crores. In a matter of one travel, one flight, I became crorepati. Was very happy. Amazing. In one travel, I became crorepati. I think I should shift my residence to different country now. When I reached there, I understood the reality. What is the reality? There, you got more money, But even if you have to go to bathroom there, you have to pay 2000 Indonesian rupee. Means what? In Indian terms, 10 rupee. Do we pay 10 rupee? 1 or 2 rupee? It's fine. And some people don't pay that also. They manage without that. That is purchasing power. So just because you have more, the currency is more, number of units are more, that's not going to make you comfortable. Same thing. Now also, uh, people say, I want to become rich. And again, I'm not talking philosophy here. The reality is, just by having more money, you don't become rich. You have 1 crore. Okay, I promise you, I'll pay you 1000 crores when you reach 150th year birthday. Okay, I'll give you 100 crores on your 100th birthday. What do you do with that? So money or anything for that matter, you are called as rich provided you have the capacity to spend it. That's what I would mean purchasing power. Just by giving money to everybody, people don't become financially independent. Very wrong myth. Especially political parties make use of it. It happened in Zimbabwe and still happening in Somalia and Slovenia and many other places. In Zimbabwe, you know what happened? The government thought people in our country are poor. So we should make them rich. How? Let's print money. How much you want? 1 crore. Print, take it. How much you want? 2 crore. Print, take it. Everybody became crore-patis. Product did not increase. So when you go to a, let's say, a bakery for a tea, now you are telling how much is tea? He tells 10 rupees. Now other person tells, no, I'll give you 1000 rupees, give it to me, I need. Other person tells, I have 10,000 rupees, give it to me. In a matter of second, 10 rupee became 10,000. Inflation increased like anything. So if you want to become rich for your personal life also, I'm telling, make sure you can earn money, very good, and you should spend money also. Again, I'm not talking philosophy here, I'm talking reality. There's no point in just making money. Money is there to help you spend. If you don't spend, what's the point in just earning? So don't focus on either things. Don't spend somebody else's money and don't go out of the country like, the greats. At the same time, don't make money so much that somebody else will sit and spend your money. Earn, invest, manage, spend it. Anyway, so there's one good saying that the money standing to your credit in your bank account when you die represents the work you should not have done in your life. Anyway, I don't want to go to that side. So the point I'm trying to tell is richness does not come from having more money. I'm not talking philosophy that you should spend and should give to everybody, donate and all. The richness comes from ability to purchase. So if a political party want to make the country independent, they say some self-reliant, whatever it is, the purchasing power should be strengthened in different ways. We can talk hours together on economics on this point, but the point, keep it in mind, purchasing power. So two countries may have different currencies, but their purchasing power should be equal. Or other way around, currency conversion rate. Conversion rates are implied rates. Implied rates based on their purchasing power. Based on their purchasing power. So what a product cost. For example, let's say one laptop. Here in India, a laptop costs 50,000. In US, the same laptop cost $1,000. The product is same in both the countries. Here it costs 50,000 rupees and here it costs $1,000. So one laptop equal to one laptop, which is 50,000 equal to $1,000. So $1 is 50 rupees. That should be the rate. That should be the implied rate. Law of one price. Currency may be different. Their ability to purchase should be same. No people should have an advantage. If they have, there exists arbitrage opportunity. Many times you would have seen people go to Dubai and come back. People don't ask you, did you see, did you went for skydiving? Did you see the Burj Khalifa there? They're not going to ask. How much gold you got? Because people see arbitrage opportunity. You don't realize, but that is the implied meaning. Here it's not, a lot of taxes are there and prices are costly. There it's cheaper. So when you come back with cheaper price purchased. But there are limitations. If there are no limitations, if there are no customs limitations, what would have happened? Everybody go, purchase, and here you sell. Over a period of time, what would have happened? Many people would have done it, and over a period of time, the price would have been balanced. But still, it's not happening. So there's a price difference. That's why people going to Dubai and coming back still find arbitrage opportunity because it's cheaper over there, and you can sell it here, or you save cost, whatever maybe. So that is called as law of purchasing power. With small example, I'll give an numericals that how arbitrage opportunity can be made, and later we do full-fledged problems. I hope you have made one small point here. Law of one price. Conversion rates are implied based on purchasing power, and if implied rate is different from actual rate, if implied rate is different from actual rate, there exists arbitrage opportunity. There exists arbitrage opportunity. Hope you have written down 3 simple points. Then we write 2 more points. How the purchasing power will happen in a forward rate. One formula I'll give. Then we can go further. Hope you written this much till here. PPPT. Purchasing Power Parity Theorem. Is it done till here? Okay, I'll go further. Okay, I'll take one simple example to demonstrate the arbitrage. Okay, let's say in India and we have USA. In India, let's say one plate masala dosa is 50 rupees. In US, $1 it cost. One plate is $1. $1. So what is the implied rate then? Because product is same for both the countries, one plate, and here 50 rupees, there $1. So implied rate is $1 equals 50 rupees. If $1 equal to 50 rupees, the product are available at same rate in both the countries, there is no arbitrage. But now imagine in USA, it is not one plate equal to $1. Let's say it is one plate is $2. One plate is $2. Now, implied rate is 50. I mean, actual rate is different, but conversion rate is 50. Let's say conversion rate is 50. It was supposed to be $1, but it's $2. It's more costlier in USA. So it's costlier in USA. And cheaper in India. cheaper in India. Now, arbitrage opportunity exists. Arbitrage opportunity exists means what? You buy in one market, sell in another market. Buy in cheaper market, sell in costlier market. So the same product you can buy in India and you can sell in US, thereby you make guaranteed riskless profit. How is it possible? In India, one plate equal to rupees 50, purchase at 50 rupees. But you know the basic concept, our starting point is 0. So what is our starting point? Can you tell me? If you want to purchase, what should be our first starting point? Starting transaction. 0 position, you know. If you want to buy, you need money. So what is our first starting point? You will borrow rupees 50. You will borrow. And once you borrow, use that money and buy one plate masala dosa. And take that masala dosa and go to US. Again, don't ask me where is parcel charge, where is travel charge. Hold on. This is assuming no transaction cost. Transaction cost, we'll have it later. This is a theory. And practically, many things are possible. Everything is online. Maybe a software, maybe a code, intellectual property. So it's possible. So this is one example. Don't apply transaction cost here. Ignore transaction cost. So you simply go to USA. You sell one plate for how much? For $2. You come back to India. While coming back to India, exchange rate was 50 rupees, but you have $2. So $2 into 50 rupees. So you get 100 rupees with you now. And you come back and repay the amount. Repay 50 rupees. Of course, along with interest, any amount. The net profit you have 50 rupees. In 1 second, we went to USA, sold it and we came back also. Theoretical purpose, conceptual purpose. So hope you're able to understand what is happening here. If the prices are not properly there in 2 countries, arbitrage opportunity exists. In fact, that is why many software companies came to India, still coming to India. Why? What is the price of a software engineer in USA as compared to in India is much, much cheaper. So what is $1,000 there? And here it is just 70,000 rupees you get. $1,000 there, just to $1,000. Here 70,000 rupees. The cheap labor means what? The labor is not same in 2 countries. The price is not same in countries. So there was opportunity, people came in. And people came in. Now slowly the balancing happening. Balance still not happened. Still balance is happening. But there will be a day when the Indian price and their price of labor becomes same. There will be a time, maybe later, over a period of time. At the point in time, they will not come here. But of course, here many more things can be given. One is labor, taxation benefits can be given. Other resources are available, natural resource, human resource. So many points will come to it. But I hope you got the overall concept. 2 countries, 2 currencies, their purchasing power should be same in the help of exchange rate. If it is not same, then there exists arbitrage opportunity. You buy in one country, sell in another country because both countries are not same. It's good for one and sell for another. You make arbitrage opportunity by movement between different countries and currencies. Okay, so what we discussed now is regarding spot rate. What about purchasing power parity in forward rates? Now, same example if I take it. Now, after 1 year, let's say, do you think the cost will be same, 50 rupees and $1 here? What do you think? After 1 year, will the cost be remaining same? Obviously, no, it will increase. What do you call that? Increase. What do you call that? Inflation. Correct. So, purchasing power parity theory says in forward markets or in forward market, implied or theoretical implied forward rate, implied forward rate, actual may be different, okay, implied forward rate is calculated after adjusting inflation of two currencies, after adjusting inflation of two currencies, inflation of two currencies. So what they say is this. So we have let's say one foreign currency equal to dot 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 local currency. Now foreign currency will have inflation, but we don't do plus inflation. We follow multiplication rule, a multiplicative model. So what do we do? I multiply it by 1 plus foreign inflation. And local currency will multiply it by 1 plus local inflation. So after 1 year, how it will become? This, if it takes to right side, now this was spot rate. The forward rate is calculated by, this will go to the right side, denominator, right? So 1 unit of foreign currency, we say forward rate equals whatever the spot rate, local rate was there, spot rate, you multiplied by 1 plus local inflation divided by 1 plus foreign inflation. You see, this comes denominator, that's why. Local inflation like in Indian inflation, and denominator foreign inflation. This is implied forward rate, theoretical rate, implied. This is forward rate, implied, theoretical, implied. And if actual forward rate is different, you know there exists arbitrage opportunity as usual. And overprice, underprice happens, all those things we discuss later. First you get the concept right. So the price in two countries should be same, and after a year means in forward rate, it should be adjusted for respective inflation. You can also remember like this. You see numerator 1 plus inflation, local inflation, denominator 1 plus foreign inflation. So you can say it's compounded by local, discounted by foreign. You can also remember like this. It helps you remembering purpose. Compounded by local, discounted by foreign. Compounded by Narendra Modi, discounted by whoever you want. You put it. I mean, just an example I have given. Don't take me personally or seriously. Compounded by local, discounted by foreign. One example I'll take. One example. Suppose Indian inflation is 10%. You know, in Indian inflation is 10%. In India, inflation rate is high. In foreign inflation, let's say USA, let's say it's 4%. And spot rate, let's say 50 rupees. So what will be the theoretical forward rate will be 50 rupees into 1 plus 0.1 divided by 1 plus 0.04. How much you get? 15 to 1.1 by 50, 15 to 1.1 by 1.04. 52.88. 52.88. So are you understanding here what is happening to the dollar? 52.88. Appreciated or depreciated or premium or discount? Dollar. 50 rupees became 52.88. It is trading at or expected to trade at premium. Why? Because their inflation is less. Interesting point. If a currency has got lower inflation, that currency will be trading at a premium. We'll write a sentence, don't worry. But logically you understand. Why is that? If somebody keeps on talking, we don't value their words much. If some people don't talk too much, but they talk little, their words becomes more valuable. I know, I can't tell that, but still. for discussion purpose. Now, a currency has lower inflation means it is not getting costlier. Lower inflation, slowly moving. It is not becoming costlier. Indian inflation, higher rate, that means what? It is increasing at a higher rate. When inflation is high, it becomes more costlier. Most costlier means if the price increases, what will happen to value? Value will reduce. In simple words, inflation, purchasing power are inversely related. If inflation increases, price increase, so your purchasing power will reduce. So a currency which has got lower inflation has got more purchasing power, more value. Therefore, they will be expected to trade at a premium. Write that one sentence. Write that one sentence. A country with lower inflation, or currency with lower inflation, a currency with lower inflation, a currency with lower inflation will have more purchasing power. Currency with lower inflation will have more purchasing power, and hence expected to trade at and hence expected to trade at premium. Expected to trade at premium. Expected to trade at premium. So basically what does purchasing power tells? No two countries should have advantage for buying or for selling. Are you clear on this one? Purchasing power parity theorem. Between two countries, no one should be advantage to buy, no one should have advantage to sell. They should be equal. That's how exchange rate should be there. If not, arbitrage exists. If one country is good to buy, other country is good to sell. Okay, hope you understood. Okay, now let me talk about one more theorem. Now, next one is interest rate parity theorem, which is very important, very, very important. Interest rate parity theorem. Okay. Purchasing power parity was talking about inflation rates. It is talking about products. But about products, inflation is very, very different. Like inflation of a software engineer price is different. Inflation of a rice is different. Inflation of a laptop is different. Inflation of your stipend, nothing is there, different. So for every product, different inflations will be there. So instead of inflation, we are substituting by interest rates, and also easy to obtain because interest rates are regulated by central banks like RBI, Federal Bank. Therefore, instead of inflation rate, we are substituting with interest rates. What does this say? As per this theorem, no country is better for investing or borrowing against another country. So what we are trying to tell you is this: anywhere you invest, in India or in US, you will have same impacts. That is, write down any benefits in money markets will be offset by loss in currency market. I'll explain it, don't worry. So basically we are telling there is no advantage. In one market, there might seem some advantage, but when you take it to another market, there is nothing like that. Let me explain you with help of an example. Okay. Let's say Indian markets, Indian stock market, Indian market or Indian market provides 10% return for investor. Whereas US market provides 4% return for investor. Now you tell me, where the investment is beneficial, where will you invest? You get more return on the face value of it, prima facie. Obviously, India seems beneficial. You get 10% return, whereas here you get only 4% return. So let's say an Indian who have rupees 100, or let's say he had 50 rupees for example purpose, he had rupees 50. What he did, he invested in Indian terms. So how much he would have got? Rupees 50 he is invested plus 10% means he would have got 55 rupees at the end of the year. But one more person, let me try. Instead of investing in India, I'll go to US and invest. And exchange rate was $1 is 50 rupees. So what he did? He had 50 rupees. That means $1. No problem. He invested for $1. And after 1 year, $1 became how much? On $1, 4% return. It became $1.04. And after 1 year, you have to convert it back to rupees. And at that point in time, let's say exchange rate was 52.88. Now please tell me how much you get. $1.04 you receive as return on investment, and will convert back to Indian rupees 52.88. 52.88 conversion rate into 1.04. 54.995, round it off to 55. He also got 55 only. Amazing, isn't it? Because you may think only 4% return you get. But what happened? 50 became 52.88. Currency got appreciated. Hope you remember this concept. An investor of India who goes to outside India not only get the dollar in foreign currency terms, exchange rate fluctuation also will be his income. Which means if I calculate 50 became 52.8, what is the percentage? 52.88 minus 50 divided by 50 into 100. You get 5.76%, approximately let's say 6%. 5.76%. Are you able to understand what is happening? It seems you are getting a benefit in India by investing at 10%. But if you invest in US, there also you get one more benefit. Here you think 10% extra I get, 10 to 4. No, on conversion rate you lose, or on conversion rate you gain. So no country, no currency is good to borrow or good to invest, if this theorem holds good. But actually it is not 52.88, let's say. Actually it is 55 rupees. Then you get more in US market. Oh, investing in US market is beneficial. Okay, it's not 55 rupees. It is only 51 rupees. Currency did not appreciate much. Then, oh, US did not give you better return. Indian market only go to give you better return. So conceptually, theoretically, it should be indifferent. An investor investing in US market or investing in Indian market. The difference in the interest rates will be adjusted, compensated by exchange rate. An US market person who was getting 6% lower return, right? And his compensation happened with the help of conversion rate, exchange currency fluctuation, appreciation. So when you compare between two countries, one seems beneficial in terms of money market, but the compensation will happen in terms of currency appreciation. Have you seen this similar concept, my dear friends, in your AS26 or Index 23, AS16 or Index 23? Remember borrowing cost. You know what they say? Compute the exchange difference. Entire exchange difference don't call as exchange difference. You compare the Indian interest rate versus the foreign interest rate. You see what is the differential. To that extent, you call it as interest. Only excess you call it as exchange loss. The logic is this. Even though it is called as exchange loss, but there is an element of borrowing cost. So reporting says don't report as exchange loss, report it as borrowing cost. Only if excess amount is there, that you call as exchange loss. Anyway, that is AS16 and AS23. I just want to give an idea. Okay. So hope you have written these two sentences. We'll analyze a little bit more. What is the impact for solving problems and what is the formula? Fine. Okay. Formula I'll write down now. As per interest rate parity theorem, theoretical forward rates is given by spot rate, same formula like IRPT, spot rate into 1 plus local interest rate divided by 1 plus foreign interest rate. One example I give. Suppose $1 equals to ₹70. Indian interest rates, let's say 10%, let's say 8%, and US interest rates, let's say 5% interest rates. Sorry. So what is the theoretical forward rate will be? Theoretical forward rate. Spot rate is 70 into 1 plus local interest rate 8%, 0.08, divided by foreign interest rate 5% divided by 0.05. So you get 70 into 1.08 divided by 1.05. 72 you get exactly 72. Okay. Okay, we can also calculate by one more method, because if it is in left hand side, right hand side currency, you are not very clear about local currency, foreign currency. Two foreign currency only given, which is local foreign if you're not able to understand. Then our usual approach, left hand side approach, right hand side approach, that also I'll show it to you. So we have $1 equals to ₹70, correct? And dollar, what is the rate of interest applicable? 5%. So we do 1 plus 5%, 1 plus 0.05. For rupee, what is applicable? 8%. So you multiply it by 1 plus 0.08. So you use this technique when rupee is not involved. If it is between dollar, euro, then the Danish krone, Singapore dollar, something like that. If two foreign currency comes, you're not very clear at which is foreign, which is local, you can use this technique. So how much will become 1 into 1.05? $1.05 and 70 into 1.08. 75.6 rupees. So what is $1 equals to? Divide 75.6 divided by 1.05. So only you get. So use this technique, or if you want one more, the local interest, normally we will take it as the right hand side currency, and foreign interest rate normally we'll take it as left hand side currency. I'm giving you multiple ways. I hope you can remember in one of the methods. Okay, it's fine. Now, forward rate, you have this. This is what you have. Now tell me what is going to be the forward premium. 72 minus 70 divided by 70 into 100. 1 year only. So into 1 year only. 2.857, 2.86. Approximately, right? 2.86. And which is what is that differential? 8 minus 5. 8 minus 5. So please write down some observations, important observations. Please write down till here, then I will dictate. Hope you're done till here. Please calculate this forward premium also. Are you done till here? Is it fine? Okay. Some observations. First point, interest rate differential is approximately same as forward premium. Interest rate differential is approximately same as forward premium. Like in this example, we had got 8 minus 5, right? 8%, 8% minus 5%, 3%. And this was the interest differential, and premium was 2.86 something. Approximately same premium. And which currency will be trading at a premium? Which has a lower interest or higher interest? A currency will be a currency with lower interest, a currency with lower interest, lower interest rate is expected to be trading at premium. A currency with lower interest rate is expected to be trading at premium. Then, if IRPT holds good, holds good, then investing or borrowing in any country is indifferent. In any country or any currency is indifferent. Is indifferent. Okay. Now, one more important point they will be asking for decision making. That is, if IRP does not hold good, which country you need to borrow or which current country you need to invest. That one important question they may ask. I would like to discuss that. Decision making for borrowing. Let's say I'll do local borrowing versus foreign borrowing. Local borrowing versus foreign borrowing. Now tell me this one. Which rate of interest do you think it is cheaper, which is lesser? You do think in local borrowing it will be less, or in foreign borrowing it will be less? Normally, I'm taking, if I'm Indian context, let's discuss. Foreign rate will be less. So local borrowing is local interest rate, whereas foreign borrowing, foreign interest rate. Foreign interest rate. But what will happen with respect to the foreign interest rate is you have to also go through one more cost. If you borrow in dollar terms, you have to go through one more cost. You know what is that cost? That is a premium, because normally foreign interest we discussed is normally it is less, therefore it is premium. So I say plus or minus premium or discount, because sometimes normally it's premium because normally foreign interest rates are less, but in some country it might be other way around also. So plus or minus premium discount. If it is premium, you do plus. If it is discount, you do minus. Actually, we don't do plus exactly. We should do multiplicative model, 1 plus 1 plus. But conceptually, it's fine. So borrow wherever cheaper. Borrow wherever cheaper. Initially started with Indian point of view, but I gave you the formula overall also, no? Foreign interest, adjust it for premium. Any two currency, this concept will hold good. In Indian point of view, I just started the concept to help you make a start, because local interest is high, foreign interest is low. But foreign interest will also compensate by premium. Reverse also can happen, but their discount will be there. So to start with, I made you think like an Indian, but now the formula looks for anybody in the world, any currency. Local interest is what? One hand. Other side, foreign interest plus premium, if it is premium. Discount, we do minus. So you borrow wherever the interest rate is less. Wherever the interest rate is less. So this formula applies for any problem, any two countries, any two currency, this applies. Okay. Now the same thing what we have, local borrowing and this foreign borrowing is a foreign currency plus premium interest, is also understood slightly one more way. Some problem they'll mention like that. So that also let me tell you quickly now. Through interest differential method. Hope you've taken down. Okay. Same decision on borrowing through interest rate differential. Through interest rate differential. So we compare two things, that is local borrowing minus foreign borrowing. You compare with premium. You compare with premium. Now, from an Indian person, I'm just taking that from Indian person point of view, local borrowing versus foreign borrowing. What is this actually going to be? In the sense, suppose local borrowing is 18, foreign borrowing is 12. That means if I go to foreign borrowing, only these two consider. Forget about premium for the time being. 18 and 12. Will I save or will I lose? Only between local borrowing, foreign borrowing. If I consider only interest rate differential. This is the amount I save by going into the foreign currency. So this is the saving if borrowed in foreign currency. Okay. Now premium is what is going to be the cost if borrowed in foreign currency. Then if net saving is higher, if net saving is higher, then borrowing is recommended. Foreign currency is recommended. And of course, if IRP holds good, nothing will be beneficial. But for decision making problems. I repeat, interest rate differential is the saving if you borrow in foreign currency. Currency fluctuation is the cost if you borrow in foreign currency. So saving minus cost, if net benefit is there, then foreign currency borrowing is recommended. Otherwise, local currency borrowing is recommended. Okay. I hope you got these points. Hope you got it. Any doubts? Okay, very good. So that's for now. Okay, let's continue to this problem now. I hope everybody is able to hear properly. There is no break in the voice, and PPT is also fine. I hope everybody join. Let's do this problem. The rate of inflation in India is 8% per annum and USA 4%. The current spot rate for USD in India is rupees 46. What will be the expected rate after year 1 to year 4, applying the purchasing power parity theory? Okay, so let's write the purchasing power parity theorem. Formula: theoretical forward rate is given by spot rate into 1 plus local divided by 1 plus foreign, and local we can also take it as RHS. Foreign we can also take it as LHS, though not always. So we have $1 is 46 spot rate. So 46 into 1 plus local inflation rate, Indian inflation rate 4%, 0.04 divided by foreign inflation rate, which is 8%. India local inflation rate is 8%. Foreign inflation is 4%. US inflation is 4%. The denominator. So if we calculate, we get forward rate after year 1. 46 into 1.08 by 1.04, you get 47.77. The hint answers are not right. You need to correct it. Anyway, this is after year 1. And we can also understand like this. $1 equals to 46 rupees. So this dollar is inflated by 4%. So you add 0.04% or 4%. And for rupees 46, this is inflating by 8%. So on $1, 4% means $1.04. And 46, 8% means 3.68 plus 46. That is 49.68. Now you can calculate $1 equals 49.68 divided by 1.04. You get same answer, 47.77. Okay, the reason I'm showing you this method is because sometimes you might get confused. What is left hand side, right hand side, multiply, divide? This simple approach you can follow. Whichever currency is there, correspondingly apply the percentage of interest. Whatever is there, you can add and right hand side, left hand respectively, and you'll be able to calculate the amount which is same. So let's calculate for second year. Forward rate for second year. Now forward rate for second year will be multiplicative model. Again, we multiplied by same thing. That is 47.77 multiplied by 1.08 by 1.04. That is considering the forward rate as a spot rate, then future rate. Or if your spot is starting from the original rate itself, then what do we do? 46 into 1.08 square by 1.04 square. Basic multiplicative model. As you keep moving to the next year, you keep multiplying by 1 plus r, 1 plus r, 1 plus r. If you start from basic year to year 2, then 1 plus r square. If you start from year 1 to year 2, only 1 plus r. I hope you know the basics of multiplicative model. So you can try. Both answer will be approximately same. Some decimals here and there can come. So 47.77 into 1.08 divided by 1.04, you get 49.61. Then forward rate of year 3, keeping this as the base, 49.61 into 1.08 divided by 1.04, 51.52. And keeping this as the base, forward rate for year 4, 51.52 into 1.08 by 1.04. $53.50. Okay. 53.50. Or if you want to directly 46 into 1.08 square by 1.04 square. That also give you the same answer. And as you can see, why the rates are increasing? 47.77, 46 it was there. It became 47. It became 49. It became 51. It became 53. Why the rates are increasing? In the sense, the dollar is becoming costlier. The reason why dollar is becoming costlier is because dollar has got a lesser inflation rate, 4%. India, we have 8%. So a currency with lesser inflation rate will be trading at a premium, like the way you are seeing here now. Okay. Hope you got this one. Let's go further. Okay, hope it is done. Okay, let's go further. Okay, moving on, come to this problem. With this, we'll understand the concept of arbitrage in forward market. Data below relates to foreign exchange rates between INR and USD. Spot $1.50, 6 months forward. This is actual given. 56. Indian interest rate 10%, US interest rate 5%. Check if IRPT exists. If not, construct arbitrage strategy. Let's calculate the arbitrage strategy. First we'll calculate under IRPT. Forward rate. Let's read the formula quickly. Spot rate into 1 plus local interest divided by 1 plus foreign interest. So in this case, spot rate 56 into 1 plus local interest rate 10%, but only for 6 months into 6 by 12. 6 months forward. So divide by 1 plus point USD rate 5% for 6 months. 50 rupees, yes, 50 rupees. So 50 into 1.05 divided by 1.025. $53.81 is it? $51 something. 50 into 1.05 by 1.025. Okay, 51.22. This is theoretical forward rate. And actual forward rate. Quoted by bank may be 56. So we have theoretical forward rate being the value kind of thing. And actual forward rate is like a price. They are not equal. Since the rate is different. IRPT does not hold good. And when IRPT does not hold good, there exists arbitrage opportunity. There exists arbitrage opportunity. Okay. Okay. Now, how to construct the arbitrage opportunity? Starting point can be arrived in two methods, but the format we are going to follow will be same. But how do you start the arbitrage opportunity? The starting point we can understand in two methods. Okay, I'll show you both the methods. Alternative one. Or regular method. what we just calculated now, the value, theoretical value is 51.22, and the price, that is actual price, actual rate. Price means actual rate, 56. Now, tell me, is it overpriced or underpriced? Price is 56. Discuss only from price point of view. Actual rate is 56. So, do you think it is overpriced or underpriced? Obviously, it is overpriced. It is high. Overpriced. And what is overpriced? The dollar. Dollar is supposed to be 51, but it is 56. So dollar is overpriced. And what is our strategy? When something is overpriced, it should be sold, right? So something overpriced means it should be sold. So you need to enter into a forward sell agreement. Forward sell dollars. Forward sell. This is the discussion under alternative 1. Another method is there. Alternative 2. Somehow institute mostly follows this, the interest rate differential method. What is the interest rate differential? When you follow interest rate differential, you don't have to go for IRPT calculation, but you should go for premium calculation. So interest rate differential, you compare with the currency premium, whatever premium. Okay, interest rate differential, 10% minus 5%, which is 5%. Premium, let's calculate using the actual rate. When you calculate premium, mind it, actual rate, which is based on 56. So 56 minus 50 divided by 50 into 100, and this is for 6 months. So into 12 divided by 6. %24. 24%. Okay, now tell me, which way borrowing is beneficial? You know, borrowing way we used to understand where borrowing is beneficial. If you go for rupee, you save 5% interest. But if you go for dollar loan, you have to pay cost of 24%. So sorry, by going for foreign currency loan, you save 5% interest. Your cost is 24%. I hope remember the concept. If you go for dollars, you save 5%, you pay 24%, which means foreign currency borrowing is not good, which means local currency borrowing is good. Or in other way around, you can tell simply, very simple, try to understand. Interest rate, you think like a local. Premium, you think like a foreign. Okay. Now, when the rate of interest is less, tell me, will you borrow at that rate or will you invest it at that rate? When the rate of interest is less, do you think borrowing at lower rate of interest beneficial or not? Of course, right? Basic concepts. Therefore, at 5%, that is local, you borrow, and at 24% you invest. Means borrow in local, invest in foreign. The interest rate differential you treat like a local, and premium you treat like a foreign currency. For local currency, you go for interest rate. For premium, you go for foreign rate. So wherever interest rate differential is cheap, that means that is beneficial to borrow. And so arbitrage exists in borrowing in local and investing in foreign. So anyway you can do it, ultimately you come to the same format, either of the format. Okay, the format is this. What is the transaction you do today? Transaction you do today, and after 6 months, that is at the time of on due date, after 6 months and due date, that is due date here. Okay, so transaction, the format is going to be very similar to the earlier one but slightly different. Look at this one. What you buy, what you sell, what you borrow, and what you deposit. This is like a P&L account balance sheet format. What you buy, what you sell, like P&L, buy, sell, and borrow, deposit, like balance sheet, asset side, liability side. So follow this tabular format, you'll be able to approach the problems easily. Now, let me tell you based on this one. Forward sell. So what is this going to be? Forward sell. At what rate? 56. This is the first point. I mean, if you follow that approach. Because the arbitrage opportunity we have identified and we have told start from entering into forward sell. Start from entering into forward sell. So starting point is forward sell 56. If forward sell, we are selling in forward, tell me what is the arbitrage concept? We have to borrow in one market, sell in another market. If we are selling in forward market, where do we buy? Buy and sell are always in opposite markets. There's a fundamental thing of arbitrage. So if you sell in forward market, where you are going to buy? In spot market. So in spot market, you're going to buy, spot buy. Dollars at the rate of spot rate 50 rupees. Okay, now tell me, if you want to buy the dollars, what do you need? You go to spot market and you want to buy the dollars. So what do you need with you to buy the dollars? We are telling spot buy dollars. So if you want to buy the dollars, you need rupees. So here we are going to do borrow rupees. Borrow rupees 50. Money is borrowing, correct. Borrow rupees. Money means rupees here. So you borrow rupees 50, go to the market, buy, pay that 50 rupees and get $1. Get $1. And you will have now what with you now? After all these three transactions, what do you have with you now today? You borrow rupees 50. That 50 rupees, you went to the market, you give it to them, you got $1. So what you have with you now is $1. So dollar is going to be deposited. Deposit $1. That is going to be the fourth transaction. And you see what we discussed in interest rate differential also same thing will happen. You borrow in local. That's what we discussed here. You borrow in local and that's what happened. You borrowed in rupees and invest in foreign and that's what happened. Deposit in dollars. And keep it in mind. Buy and sell are always opposite. Borrow, deposit are always opposite. If you buy in spot, sell in forward. Buy in forward, sell in spot, opposite. And borrow, deposit. If you borrow in rupee, deposit is dollars. If you borrow in dollars, deposit in rupees. Please write a note on this one. Please write a note on this one. Please write a note on this one. Buy and sell will happen in opposite markets. 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 That is forward sell. Forward sell means spot buy. Forward sell means spot buy. Forward sell means spot buy, and forward buy means spot sell. Forward buy means spot sell. Forward buy means spot sell. Fine. First point. Next one. Borrow and deposit will happen in opposite currencies. 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 Opposite currencies. That is borrowing in local currency. Borrowing in local currency means investing in foreign currency, depositing in foreign currency. Borrowing in local currency means depositing in foreign currency. Depositing in foreign currency. And borrowing in foreign currency means depositing in local currency. Depositing in local currency. In local currency. Okay. Now after 6 months, there are all consequences. Everything will be settled. Deposit $1. Deposit matures along with interest. Deposit matures, and borrowed earlier now need to be repayment to be done along with interest. Let's see how much it is. Deposit matures. How much? $1 you deposited. Interest rate of on dollars. Interest rate is 5% for 6 months. So I think you get $1.025. $1.025, and $1.025 you have. How will you get rid of it? How will you close it? How will you sell it? You have already entered into a forward sale agreement. Execute it. Execute. And this spot buy opposite transaction will not happen, because anyway we are doing forward sell. We are executing it. So that one you can just mention. This one, you are executing it. That spot buy is sold in forward market. Execute it. This is sold in forward market. Or you can just say blank. Execute it. Because you are not selling $1. You are selling $1.025. So how much rupee you get? $1.025 multiplied by 56. This is dollars. So you get rupees. ₹57.4 you get. 57.4. But repayment will have to happen. You borrowed 50 rupees. Repayment you do 50 rupees into 1 plus rate of interest is 10% for 6 months. $50 into 1.05, 52.5. So you are receiving 57.4 rupees, receiving, and you are paying 52.5. So what is the overall surplus going to be? Overall surplus. 57.4 minus 52.5, 4.9 rupees. 4.9 rupees. Okay. And one more thing I always told you, you can always verify arbitrage gain. Can you verify this number? Arbitrage gain 4.9. Is it the difference between value and price? What is the difference between value and price? 51.22 minus 56. 4.78. Oh, number is not matching. There we got 4.78, here we got 4.9. You know why it's not matching? Because 4.78 is for $1. And this profit what we got is how much dollars? We sold $1.025, right? So 4.78 what we have multiplied by 1.025. You get the answer 4.9 for you to verify. In the interest rate differential method, you can't verify. You have to arrive at that. But in our IRPT method, you can verify the answer. Okay, hope you got this one. Let's go further. Now we are going to one very important area, definite question in exam, that is foreign currency exposure hedging. Basics of hedging, you know, have a backup before breakup. That is basically protecting your risk. In foreign exchange, what risk is there? What are the various instruments available? And to what extent risk can be managed? All those things we have to understand here. We have discussed the hedging even in index futures, portfolio hedging using index future, in derivative delta hedging, I mean using delta, that portfolio replication approach. That was chiller. Now this hedging is the real monster, because in foreign currency hedging we have various alternatives. In the exam they'll ask you which alternative is suitable in a given situation. So what do you mean by hedging? Risk reducing or avoiding risk. And what is the risk? In this chapter, of course, this chapter itself risk for most of you. The exchange risk keeps fluctuating. Conversion rate, that is the risk. And what we are trying to do is, because of the exchange rate fluctuations, inflow or outflow is uncertain. For exporter, inflow; for importer, outflow is uncertain, and we are trying to stabilize that, making the cash flow certain. Sometimes absolute certainty is possible, for example by entering into forward contract, even by doing money market hedging. And sometimes we may not be able to protect 100%, for example if I go for futures. So making the cash flow certain to the extent possible. Okay. Now coming to the types. What are the hedging mechanism possible? We have forward hedging where we enter into forward contract. Simplest of the all. We have money market hedging using the operations in money market, which means using deposit in dollars, deposit in rupees, or borrowing in rupees, deposit in dollars, something mixture of deposits and borrowing. That's called as money market hedging. Concept of netting, setting off. If you have receivable and payable, we can do set off. We have leading and lagging. We do set off, advancing, or we extend, postponing. That's called as leading and lagging. I'll explain that. Then using foreign currency exposure hedging, option hedging, future hedging, currency futures. We also have other type of problem. If you've already taken a foreign currency loan, how do you cover it? Forward cover or money market cover? Or we have a particular variety of problem called as the supplier credit versus bank credit. So many varieties of problem. Even letter of credit, one concept is there. All those things ultimately will come in this area. So many areas are there. Let's try to have an overview of each of these areas. We also have currency swap. Maybe currency swap, I will not cover it here. Maybe I'll cover it in the interest rate management chapter. Because interest rate swap, that becomes currency swap. Okay. Now, let me try to cover first two things. That is forward hedging and money market hedging. Called as forward cover, money market cover. Let me explain. Give me a second. Okay. Hedging for exporter. I will explain forward market also. I'll explain money market also. I'll also try to cover the basic concept of hedging once more. Imagine you are a exporter. And what does the exporter do? He will sell goods to his customer and he will receive the payment. But the payment he will not receive immediately. He'll give the credit, he'll give the time to make the payment. So customer will make the payment in dollar terms to you. You are an exporter. You receive US dollar when? After 3 months. You are an Indian person. You receive USD. What do you do with that USD? You will have to sell in the market, in the currency market, so that you get the rupees. But when will you come to know that conversion rate? Only after 3 months. When you actually go to the market, go to the bank and say, give the dollar, take the rupees. And how much rupees you get? Depends on whatever is the spot rate on that point in time. And that rate, do we know today or will come to know only after 3 months? Definitely will come to know only after 3 months. And that is why it is uncertain in nature and it is called as a unhedged position. It is called as the unhedged situation. Unhedged. Uncertain. Risky position. Unhedged position. Where the spot rate will be known only at the time of settlement, not known earlier. This is the risk you are exposing. How much rupees you get, we don't know. Let's say we are in December 2021. 3 months later, by March end, you receive dollars. What will be the conversion rate by March end? We don't know. Maybe corona situation would have increased or decreased. Some more third variant, fourth variant, fifth variant. What would have happened to us? We don't know. Uncertain. It might increase also. It might decrease also. In exam, they'll ask you that question also. Unhedged situation, what would be your position? Of course, that you'll come to know only on expiry. But as a post-mortem analysis, we might have to give comparison. Had you done forward hedging, what would have happened? Had you done money market hedging, what would have happened? Had you kept the position open position, unhedged position, what would have happened? Then we say, oh, this would have been the best. As a post-mortem analysis, of course, not known earlier, this will be known only on expiry date. Okay, now this is the situation we are trying to avoid to the extent possible. And that process of removing this risk, managing this risk is called as hedging. Now, you are going to worry about what rate I get, I don't know. I know I'm going to sell USD. What rate I will get, I don't know. So you agree upon a rate. That US dollar you give, but the rate at which you receive, you agree upon a rate. That is what is called as a forward rate. And what forward market you go? You are going to enter into forward sell, right? You are going to do forward sell. Why forward sell? Dollar I'm selling. So it's going to be forward sell contract. So forward sell contract is called as forward hedging. If I keep it open, that's called as unhedged position. I enter into a forward contract so that the rate at which I get my money is fixed today, predetermined today, called as forward rate. This process is called as forward hedging. In the exam, what are the other kind of question you can expect? You can expect, had you not done the hedging, how much would have been your profit or loss? Impact of hedging. By entering into hedging, let's say the rate is 72 and unhedged position, it happens to be 73. So actually you lost by hedging because you lost the 1 rupee opportunity. But if the rate was 71, actually you saved 1 rupee, you gained 1 rupee. Notional profit or loss can be asked in the exam. Okay, now here is one more method, that is money market hedging. How do we do money market hedging? Think this now. You have US dollar with you, which you receive from customer. One option, you can sell in the spot market, that is unhedged position. Second position, you can sell in the forward market, a rate committed earlier, that's called as forward hedging. What is the other way of disposing the US dollars? Remember, you receive USD from your customer, USD is on your hands. What you do with that? You deposit again. No, I want to get rid of now. I sell in the spot market, it's uncertain. I sell in the forward market, forward hedging. What else you can do now? It's a very interesting situation. You use it for repaying a US dollar loan. Means you take the loan today. Or hedging technique, what most people say, you have an asset, you have a receivable amount, right? You have an asset. For that asset, you create a liability. You have a receivable in USD, dollar asset is there, you create a dollar liability, you take a dollar loan. So you borrow USD today, you don't deposit USD. Borrowing and deposit cannot happen in the same currency. So you borrow USD, you convert in the spot market to rupees and deposit rupees. And on maturity, after 3 months, this deposit matures. Borrowing you have to repay. No need to worry about the borrowing repayment. Why? The dollar comes from the customer, give it to him. That's all. That is, borrowing will be repaid. So US dollar comes from a customer, you repay to the bank, dollar loan, dollar assets, set off. It's closed. But rupee deposit will come. That is your effective proceeds. And one point to be kept in mind, when you do borrow, don't borrow amount equal to invoice. If receivable is $1 lakh, don't borrow $1 lakh, because after 3 months the loan 1 lakh will be added with interest. So you should take a loan such a way that it will be equal to invoice amount, repayment amount along with interest. In other words, we do a present value of USD at a borrowing rate. So along with interest will exactly be equal to the invoice amount. And US dollar, you are converting to deposit rupees. So you are going to use a sell rate, dollar to rupees. Dollars is sell and rupee or deposit. So deposit rate. So ultimately whatever you get, that is the effective proceeds, deposit mature, effective proceeds under money market hedging. You can take a quick screenshot of this maybe. You can copy it down later. Because I would like to give a overview of the hedging. Later when you do problems, you can revisit this concept, apply this concept and you can solve the problem. But at this point in time, I want to give an overview of different hedging technique available. So money market hedging for exporter. Okay. So in the exam, they'll ask you compare money market cover, forward cover. Forward cover, amount you get by selling using forward rate. Money market cover, here deposit maturity, that is your effective inflow under money market hedging, whichever is higher, exporter, whichever is higher, that is his cash flow for him. We have to recommend suitable strategy. Okay, now you observe here. This process of thinking to replicate in exam is very, very difficult. I have a solution for you. Don't worry. Just focus on this process. What essentially we are doing? I am doing present value, then I am doing future value. Okay, so for this spot rate, if I apply, what and all I am doing, this I am doing present value divided by 1 plus R to be specific foreign interest rate, and this I am maturing deposit, I am compounding. So I am multiplying by 1 plus R. So while discounting, I am using USD rate. I am compounding, I am using rupee rate. That means compounded by local, discounted by foreign. Have you heard of this sentence somewhere? Have you seen this formula somewhere? We take the spot rate. Numerator, I do 1 plus local rate. Denominator, I do 1 plus foreign rate. That is interest rate parity theorem, right? So there is a shortcut which we can apply for money market hedging, for exporter as well as importer. I'll show you that shortcuts. Okay. So what shortcut we can do is this directly. For exporter, we are trying to understand how much amount you receive. For that purpose, what you have to do? You start with the invoice amount. Easy. Spot rate. Easy. Then money interest rate parity theorem. 1 plus local rate by 1 plus foreign rate. Very easy. Now, the problem is, sir, how to decide sell, how to decide deposit, how to decide borrowing. I'll tell you the logic. You are doing for an exporter. Exporter, what is his nature of operation? Exporter sell, sir. Exporter sell rate. Now, once exporter sell, what he has? Asset or liability? Exporter is receivable. So he has the asset and deposit in numerator, opposite denominator, borrowing. Numerator local currency, denominator foreign currency. Let me write for importer now. If it is a problem on importer, what he will do? Invoice amounts, that is same, into spot. Importer is a buyer. Spot buy rate into 1 plus local currency by 1 plus foreign currency, that is interest rate parity theorem, that is fixed. That is fixed. Then what is the nature of importer? He will have a liability. Therefore, in numerator, I will have a liability, that is a local currency liability. That is, you can say deposit, rupee liability. Denominator, opposite, deposits. Straightforward thing. Sir, do we get the answer if I write the answer in one line? My expectation is no. Sir, we are getting the answer in one line. Why they don't give marks? You get the answer in one line. But practically, do we achieve this directly by one line? One transaction? No. You have to follow a series of transactions which results in this shortcut. So you should give us a knowledge. You should express in the exam what are the series of transactions. You have to show the steps. So for step purpose, you can follow this format. First step, you do this denominator. Second step, you do spot sell. Third step, you do deposit. I'll explain this. Take a look at this. So if it is for exporter, first step, I borrow in foreign currency. Second step, I spot sell. Third step, I deposit and gets matured. In case of importer, I do present value for deposit foreign currency. That much amount I will buy and then I have to borrow and repay. Remember like this arrow, starting down, going left side, going right side. One step, second step, third step. So this will tell us the series of transactions involved, which will give you the marks. So remember the shortcuts and the steps we are going to write. Denominator 1, go to numerator 2nd, and right side 3rd. 3 steps, shortcut. Money market hedging done. Forward hedging, as simple as I can say. For importer, he will do forward buy. He needs to buy. Exporter, he will do forward sell. Simple. So any doubts in the money market hedging in the steps, shortcut steps, which is what we are going to apply while solving problem as well. But writing only this one line, you will not get marks. If the valuer is in very good mood, he might get, but mostly they will not be. So I recommend you can use the shortcut, remember the steps, but you have to present using steps. Steps carry marks. Okay, so this is about money market hedging and currency hedging, forward hedging. We have some more varieties. Let me cover one by one. Okay, next. Okay, next we have this concept of netting. Netting. Netting means what? Set off. If you have receivable and payable on the same day, receivable and payable on same day. So what do you do? Instead of converting it to rupees, you can directly ask them to make the payment. Direct payment from customer to supplier. What do you mean by that? You have $1 lakh receivable. You have $1 lakh payable. Then what do? You tell your customer, don't transfer it to my account, directly make the payment to my supplier. What is advantage now? In that case, you don't have to convert it to rupees, which you need a forward sell contract. Then from that you have to buy dollars. So forward buy contract. So both the rates you can save. So you don't require sell contract, you don't require buy contract, and also you can save transaction charges because spread will be there in buy rate, sell rate, margin will be there, time gap will be there. You tell the customer, make the payment directly to the supplier. Set off done. No need to convert to rupees. You save charges, you save spread. That is set off. But what if receivable and payable are on different dates? Receivable and payable are not on same date. Are not on same date. Then we have this two alternatives available. Either we do leading or we do lagging. Let me explain. What is this leading or lagging? Leading means what? Suppose receivable after 1 month, payable after 2 months. Time gap is there. Now, what do you do? Payable after 2 months, you tell the supplier, I'll pay after 1 month only. Give me some discount. Cash discount I will get. You understand? You pay in advance, or if receive in advance, you tell the customer, pay me in advance. For which there will be cash discount. So leading means it will have payment in advance. Payment in advance. And then set off. So that you make the time equal, and payment advance means there will be cash discount involved. Payment in advance, making it equal, and then you do set off. That is, you ask the supplier to make them, you ask the customer to make the payment to supplier. But here there will be cash discount involved, you should be careful. Cash discount involved. Cash discount involved. And you have lagging. What is lagging? Receivable 1 month, payable 2 months. You tell the customer, don't pay me now, pay me after 1 more month. Or payable is after 1 month. Then you tell the supplier, I'll pay you 1 more month later. You are delaying the payment. Lagging means delaying the payment. And delaying the payment and then set off. Delaying the payment and then set off. This process is called as lagging. And this will not have cash discount. This will have interest components. You are paying later. Supplier will say, pay later. Why will you do charity? Say, pay me interest. Right? If you're lagging, if you're delaying, then there will be interest either with the customer or with the supplier. Then you ask them to make the payment to each other. I mean, you ask the customer to make the payment to supplier. Set off will happen. Of course, by considering all these cash flows, we have to make a decision overall which cash flow is beneficial. No formulas here. We have to do under two alternatives. For importer, whichever cash flow is cheaper, we select. For exporter, whichever cash flow is higher, we select. But the process, the concept is this under netting. So we have understood unhedged position, forward cover, importer will go for forward buy, exporter will go for forward sell. Money market hedging, shortcut also explained. Netting, which involve the concept of leading and lagging. Okay, now. Next, one more type of problem typically comes in examination problem, especially from Indian point of view only. That is the supplier credit versus bank credit. In the sense, you are an Indian person, working capital management problem. You are borrowing or you are purchasing goods from Japan, you are purchasing goods from Germany, but making a payment after 3 months. But instead of making payment after 3 months, if you make the payment immediately, two alternatives are there. If you make the payment after 3 months, supplier might charge you interest. He say, you are paying me after 3 months, so pay me some interest. But if you take a loan from Indian bank and pay them off immediately, you save interest there, but you will have to have interest in the local bank. It's like a local borrowing versus foreign borrowing problem. Should I take the supplier credit or should I take the bank credit? What are the cash flows involved? I quickly summarize the chart for you. Supplier credits. If you use, that means you are using his interest rate. He might charge you interest. That is like foreign interest rate. Bank credit. You're using the local bank like overdraft. So local interest rate you are paying. Conversion rate, which will you use? That's a very interesting situation. Means, are you using the spot rate or are you going to use the forward rate? Supplier credit, when are you making him the payment? Are you making him the payment immediately? No, you are going to pay after 3 months, after 4 months. So forward rate is relevant. Now bank credits, when are you going to make the payment to him? Immediately. That means you are making the payment today, so the conversion rate required is spot rate. Now why this discussion is required, that too in Indian context? In Indian context, rupee usually depreciate at least against dollar. So spot rate will be cheaper. So if you look at that angle, oh, bank rate is beneficial. But you compare interest rate, local interest, foreign interest, rupee and deposit, which is cheaper normally? Deposit, I mean, dollar is the cheaper, rupee and dollar is cheaper. Oh, this interest rate is cheaper. You understand? In supply credit, we have one benefit, interest rate is cheaper. In bank credit, we have one benefit, spot rate will be cheaper. So in advance, we can't tell which is beneficial unless we calculate cash flow under both alternatives. In that context, one small point to be kept in mind: interest rate do we add first, or exchange rate do we add first? If you remember the sequence, the process becomes easier. Okay. Now, in supply rates, what do? You add interest, then you make a payment, right? Because interest is added by supplier and then you make a payment. So, interest rate comes first, conversion rate comes later at the time of settlement. Whereas bank rate, you have to make the payment immediately. Today only you need to know the exchange rate. So exchange rate comes first. That amount equivalent you are going to borrow. So you pay interest rate. Okay. So what kind of questions will be there in exam? They will give you. Supplier is giving you 90-day time to make the payment, but he will charge you 1%. Second alternative, you can make the payment immediately by taking the local borrowing, maybe bank overdraft, but banker will charge you 4%. Which alternative is beneficial? Recommend. What you should do? Alternative 1, alternative 2. Alternative 1, borrowing in foreign currency using supplier credits. The invoice amount plus interest rate. Invoice amount plus interest rate, that is the total amount to be paid to supplier after 3 months. Let's say take 3 months forward rate, that is the effective cash outflow under supplier credit. Alternative 2, cash flow under bank credit, make the payment immediately, invoice amount into spot buy rates. You have to buy the dollars to make the payment to customer. So spot buy. So low invoice amount into spot buy. This is the cash flow that will take place, and equivalent amount you borrow from bank. So spot rate into exchange rate. That is the today cash flow. That amount you borrow. Along for that you add the interest rate charged by the bank credit. Total payment after 3 months. So two alternatives you compare. Whichever cash flow is less, that one you are going to recommend from importer point of view. This problem will always be from Indian person, don't worry, and this problem will always be from importer point of view. It's a specific particular problem, importer point of view. Okay. There is one more line of question which can be asked along this line, along with this one, which is called as a LOC, letter of credit. LOC, letter of credit. What is LOC? You don't have to worry much. It is a supplier credit plus LOC. There is you're taking a loan from supplier. No, he's from another country. He says, how can I believe your country? That you are from India. You understand? So you give him some guarantee. You give him some surety. That guarantee is called as LOC, letter of credit. So you do plus letter of credit. So if letter of credit problem is there, it is same thing, but one extra cash flow will come, letter of credit. That is a guarantee given by Indian banks to the foreign banks or to the supplier directly. It's a guarantee given, letter of credit. It's given by Indian banks, okay, in bank in India. It is a guarantee given by your bank, local bank, guarantee given by local bank. And why will they give guarantee just like that? They will charge interest. So there will be something called as a LOC commission. LOC commission, because they'll charge. And LOC commission is a percentage on invoice amounts. It's calculated a particular percentage, 2% on invoice amount, something like that. It's a percentage on invoice amount and payable today. But we are all calculating all the cash flows at the expiry. So what you are going to do? You are going to add interest. Interest, how do you calculate? Interest by local bank, because you have to make the payment to the banker, means today you should take the loan, not the foreign loan. You should take the local bank loan. So it's going to be interest rate, which is bank rate, bank interest. Interest by, or let's say local interest, local bank interest. So there will be 2 points to be kept in mind if LOC is there. First point, you have to calculate commission. How do you calculate commission? This commission is calculated by the invoice amount into the percentage of commission into the spot buy rates. Why spot buy rate? That is the amount of commission I should pay my bank in foreign currency. $1 lakh, 2% commission, $2,000 I have to pay them. That means that much I should buy in the market, that much rupee I have to borrow. Therefore, calculation of invoice amount, calculation of LOC commission, invoice amount into percentage, into spot buy rate, that much I borrow today, so I'll add interest, that to local interest, which will add to my cash flows. So if LOC is there, two cash flows will come. One, LOC commission. Second, interest on the time value of money that will get added to your cash outflow in supplier credit. Then you make a decision whether it is worthwhile to do supplier credit or bank credit. Okay. And one more type of problem you know already, but I'll just repeat once more. That is on local borrowing versus foreign borrowing. I'll explain, I'll do it once more. Local borrowing versus foreign borrowing. They'll tell you like this. You have a project coming up which requires $1,000 or $1 million. Two options you have. One option, borrow $1 million from a foreign bank, or equivalent amount you borrow from local bank, then convert it dollars, make use of it, or vice versa. You need 10 lakh rupees for your business, you borrow 10 lakh directly, or you borrow dollars, then convert it to 10 lakh rupees. Local borrowing versus foreign borrowing. One method is there, like the way we did in supply credit bank rate, loan amount today, interest payable after repayment time. Foreign borrowing, equivalent loan amount today, along with foreign interest, then repayable foreign borrowing into forward rate, wherever the cash outflow is high. So you can do like that. Okay, let me just show it. If it is local borrowing, then what will be the cash flow? Whatever the amount of loan taken plus interest, local interest. This is the total repayment amount. That is one method, straightforward. Second, if you do foreign borrowing, you should take the amount of loan, dollar loan, foreign currency loan. How do you calculate the foreign currency loan? Sometimes directly available, sometimes if not available, whatever the project amount in local currency divided by spot buy rate. Because you have to convert it to rupees, or you divide by the spot rate. Buy or sell, you decide later. You divide by the spot rate. That is the amount of dollar loan, foreign currency loan. You add a foreign currency interest. Then you do repayment into forward rate, forward buy rate. Why forward buy rate? Because there is the amount of foreign borrowing you have to repay. That is forward buy rate. Then you choose whichever is lower. Whichever is lower, that becomes your recommendation. This is calculation till the final amount, like the way supplied bank rate. Or you can do one more method using IRPT also you can do using IRPT. Remember IRPT, we calculate interest rate differential. Interest rate differential. Then we compare with forward premium. So if interest rate differential is cheaper, you go for local borrowing. If forward premium is cheaper, then you go for foreign borrowing. This is another way of giving the recommendation. So this is the problem on particularly local borrowing versus foreign borrowing. So local borrowing means amount of loan taken plus the interest. This is the amount of repayment you are going to do. If it is foreign borrowing, then project amount 1 lakh rupees, 10 lakh rupees divided by spot rate gives me the amount of dollar to be borrowed, foreign currency loan to be borrowed, plus the interest rate in foreign currency, repayment in foreign currency multiplied by the forward borrow rate, that will give me the rupee terms, local currency terms. Or using IRPT, interest differential versus forward premium. If interest rate differential is cheaper, local borrowing, forward premium is cheaper, I'll go for foreign borrowing. That is another way of explaining or giving the recommendation. Okay, very good. So money market hedging, forward hedging, leading, lagging, netting off, and then the supply rate versus bank rate problem, local borrowing, foreign borrowing, that kind of problems. Okay, then we have a particular variety on forward market disposal that I will discuss it later. Now I'll come to uh, two more important aspects. Again, problem will come later, but two more important aspects where many people again have an issue, that is hedging using foreign currency future, hedging using foreign currency options. So let me explain that. So I'm just trying to give an overview so that you get an idea first. Then when you do problem, you get a clarity as what to be applied. Okay. Currency option. Currency option. First of all, I assume you know what you mean by options. Options mean it's a contract entered today to be settled at a future date at the option of the holder. Holder will decide. Call option, right to buy the underlying asset. Put option, right to sell the underlying asset. Holder pays the premium. Writer receives the premium. I'm not repeating all those things. I hope you know it. It's an auction contract where the underlying asset is a currency. We have discussed in derivative chapter, underlying asset is shares or even index or commodities. Underlying asset is a currency. So you will have option premium payable by the holder to the writer. Holder gets the right. What right? Right to buy? Not today. On expiry dates. And what right? It might be right to buy or it might be right to sell. Right to buy, that's called as call option. And if you have right to sell, that's called as put option. At what price you get the right strike price decided today. On which date? Expiry dates. Okay, these are the special regular feature. What is intrinsic value? Premium. Intrinsic value minus premium is called as payoff. What is break-even point? What are the different strategies? I hope you can recollect all those things. But apart from all these regular features, in currency option, there is one special feature, very interesting one. See, in underlying asset where it is share, you have right to buy the shares. It's called as call option. Similarly, if I have USD, right to buy the USD is call option, right to buy. But if I'm buying USD, I have to pay rupees. So, a call option on foreign currency is an implicit put option on local currency. Similarly, a put option on foreign currency is an implicit call option on local currency. So, this is where people will have a confusion in the exam. For hedging purpose, should I go for call option or should I go for put option? If I have to give a shortcut, if it is direct quote, 1 unit of foreign currency is equal to units of foreign currency. If it's a direct quote, you go for call option buy, put option sell. But if it's indirect quote, you should do reverse. That's a shortcut, still may be confusing. So what I have done is I have designed a particular process. I'll share that process with you. Let me explain the charts. Then if you have any doubts, we can address that. Okay, let me explain. Okay, take a look at this. Option hedging, three-step process. Three-step process. Logically only I have designed. It should not be confusing. First focus, then you can take it down or you can take a screenshot. First step, identify the type of option. That is where many people have confusion. For hedging purpose, should I go for call option or put option? Follow the steps, you'll get the answer. Quotation, you will have 1 unit equal to so much, $1 equal to 50 rupees. Strike price, no, $1 equal to 50 rupees or 1 pound equals to $1.5. Quotation will be there. The left hand side, what is there? No, that is the underlying asset. $1 equal to 50 rupees. Dollar is underlying asset. 1 pound equals to $1.7. Pound is underlying asset. Left hand side is underlying asset. One more way, you will have lot size. Lot size, the multiple of that only you have to buy. Reliance share 250 lot size. Infosys 600 lot size. Index Nifty 50 lot size. Bank Nifty 25 lot size. That lot size. So whichever currency mentioned in lot size, that is the underlying asset. You can also remember like that. The currency of lot size. For example, one lot, 1,000 pounds. Pound is underlying asset. One lot, 1 lakh rupees. Rupees underlying asset. The currency of lot size. Currency of lot size is also, you can say, underlying asset. Then you see, with respect to underlying asset, am I purchasing or am I selling? If underlying asset is purchased, you go for call option. If underlying asset is to be sold, you go for put option. Example, take a look at this. Lot size. Okay, $1,000. And we are talking about an importer in India who wants to import in India. He will buy dollars, right? He has to make the payment to supplier. He needs dollar. So in the option contract, you need to buy dollars. Get the basic process. You get the money from the option contract, you make the payment to the supplier. So to make the payment to supplier, I need dollars. So dollar to be purchased. Sir, what is the underlying asset? Dollar. What I'm doing with respect to dollar? I'm buying dollar. I'm buying dollar means call option. Fine. One more example. Lot size is $1,000. We are talking about an importer in Europe. Okay, importer in Europe. European is borrowing and is purchasing goods from US. So European needs dollars. He is going to buy dollars in options. So underlying asset is dollar. You are buying dollar. So what you are going for? Call option. Okay. Now please let me see if you are able to do it. Lot size is 10 lakh rupees. Lot size 10 lakh rupees. You are talking about an exporter in India. Can you tell me call option is appropriate or put option is appropriate? Of course, exporter in India to, let's say, USA. Do you think call option or put option? Normally, what do you think? Straight away, exporter, sell, put option. But I told you, don't do that shortcut. It will not work. Look at the process. What is the underlying asset here? Lot says 10 lakh rupees. So, what is the underlying asset? Rupees underlying assets. Whichever currency lot size mentioned, that is your underlying asset. Lot size 1 lakh pounds. Pound is underlying asset. Lot size 1000 euro. Euro underlying asset. Lot says 10 lakh rupee, rupees underlying asset. This is a particular area where people are confused. Where lot says in rupee, basically indirect quote. Okay, now rupees underlying asset. Hope that is clear. Okay, now as an exporter in India, what you have to make? Dollar you will receive from the customer and you sell in the market. Dollar you are selling. But is the underlying asset dollar? No. Dollar you're selling means rupee what you're doing. Rupee I'm receiving rupee. I'm getting rupee. I am purchasing rupees. If the underlying asset was dollar, I would have gone for put option. But the underlying asset is rupees. Rupee I'm getting. Rupee point of view I should think. So it is call option. One more example I'll give. See if you're able to do. Lot size, in this case I will give a different thing. Let's say 1000 pounds. And he is an importer in UK. Okay, so importing goods from USA. Importer in UK. Importing from USA. Now, what is the underlying asset in this case? Can you tell me? Basic thing. Underlying asset is pounds. That is clear. Now, second point. Importer in UK means he is buying the goods from USA. So, how much payment he has to make? What currency he has to make is dollars. But he needs dollar, right? Hope you're able to get. As an importer in UK, I have to make my supplier payment in dollars. I need to buy dollars. Oh, very good, sir. Importer buy dollars. Correct. Importer will buy dollars. But what is the underlying asset? Pounds. So it is not buying dollars. You have to sell pounds. Both are same. But dollar is not the underlying asset. Underlying asset is the pounds. So selling pounds means it becomes put option. I hope this is clear to you. I'll give once more. Let me see if you are able to do. Lot size, let's say 1000 euro. You are talking about an importer in Europe or Germany from UK. Now, what option do you think is suitable? Call option or put option? First step, think about the underlying asset. Second step, thinking from that underlying asset, am I buying or selling? The same explanation I'm telling will also be applicable for futures also. Importer in Europe. Think slowly, it's okay. Importer in Europe from UK. So, what is his obligation? Can you tell me? What is his obligation? Which currency he needs to purchase to be able to make a payment to a supplier? Supplier is in UK. He is in UK, not USA. In UK. He needs to purchase pounds. I hope that is clear. He needs to purchase pounds. Okay. But look at the underlying asset. Is the underlying asset pounds? Euro. So you should not tell buy pounds. You will tell sell euros. Both are same only. So selling euro means we go for a put option. If the lot size was not 1000 euro, if the lot size was 1000 pounds, now pounds only underlying asset, pounds I'm buying, I would have gone for call option. It's as straight as that. In every transaction, I buy something, I sell something. You do one thing. More than lot size, first you think what transactions you're doing. Buy one currency, sell one currency. That will happen in every transaction. And then see the underlying asset. With respect to underlying asset, what I'm doing, buying or selling, accordingly you do that. Hope you're able to do that. So first step is identification option. The same thing is applicable for futures also. I'll show you the process, you understand. Okay, here comes small challenge because of lot size again. Number of contracts. If underlying asset and invoice are same, example I gave you, underlying asset is pounds, invoice amount is also pounds. If both are same, lot size calculated by invoice amount by lot size. Invoice amount 10 lakh, lot size 1 lakh, 10 lakh by 1 lakh, 10 contracts. But if invoice amount is in the pounds, but underlying asset is in dollars, there is a mismatch. When, especially in this case, no, when you do opposite, you feel like call but you select put, you feel like put, you select call, in that case it will happen. Where if the underlying asset invoice amounts are different, then invoice amount divided by strike price, invoice amount in dollars divided by strike price in pounds, that will give you pounds. And when you get the pounds, lot size in pounds, you'll be able to get the number of contracts. So if invoice amount and underlying assets are different, then you should convert the invoice amount. How do you convert? By dividing strike price. And on you have cash flows calculations. What are the cash flows calculations? On expiry, you will compute the cash flow. How cash flow? A number of contracts into lot size into strike price. Number of contracts, 10 contracts. Each contract 1000 units into 1000 multiplied by strike price. You will never divide by strike price. Always multiplied by strike price. But you know, if call option or put option will be exercised only when it's beneficial to you. If it is not beneficial, you don't do strike price, you do market price. Correct? If the option is not exercised, then don't multiply it by strike price, you multiply it by market price. But usually, if standing today, I don't know what will happen, so I'll assume that strike price is exercised. But if they give you information, what would happen on expiry date, then I'll select the market price. One more thing they can do it. You know what? One more thing what they do. They will give you probability on expiry. It can be 1.8 per pounds or 1.7 per pounds, 1.9 per pounds. They will give you various possibilities, probabilities. Then under each probability, we'll calculate the cash flow multiplied by the probability, expected value approach. That's what we do on expiry, if probability is given. Anyway, when you look at the problem, we'll appreciate better. If any fractional thing can come, yes, because the number of contracts may be rounded off. If fractional thing comes, then we enter into a forward rate for that fraction. On inception, at the beginning, you have to pay premium. So premium calculation will be number of contracts into lot size, same formula. Number of contracts into lot size, same formula. You don't multiply it by strike price, you multiply it by premium. One extra situation will happen here, one super concept which will happen, that is in this case, when the underlying asset and invoice are different. No, in that case, premium you will get in foreign currency. You are an Indian. Underlying asset is rupees. Premium you will get in dollars. So when premium is in dollars, when premium is in foreign currency, you will have one extra step converting it into local currency spot buy. And interest on premium, some problem institute considers it, some problem institute don't consider it because premium is payable today, but the strike price payable expiry. There is time value of money. So on the amount of premium, uh, sometime interest is considered and sometime interest not considered. So in the exam, you can do both, give a note. But one point remember, all this hedging is only from holder point of view, not from writer. We are not thinking at all from writer. As an option holder only we are deciding, not as an option writer. And one more small point, strike price and premium are like conversion rate. What's the nature of conversion rate? When I multiply by the conversion rate, another currency is obtained. For example, let me take this one. Okay, number of contracts, 10 contracts. Lot size is let's say 1000 pounds, and premium is let's say 1 pound equals to $0.25, so multiplied by 0.25. What will be the answer here? Will the answer be dollar or will answer be pounds? Answer will not be pounds, because this is the pounds. On that I am applying the premium rate. Premium rate are like conversion rate. So when I apply conversion rate, I will get the answer in dollars, like $250. Now $250, should I keep it in dollar terms or should I convert back to pounds? If the problem is from US person point of view, $250, keep it that as the cash flow. But if the problem is from European, or if the problem is from UK person point of view, British point of view, then dollar is a foreign currency. You can't stop it at foreign currency. You convert it to local currency using spot buy rate. This particular situation I'm explaining, hope you're able to follow it. I'll do one more. Suppose it's given 1 euro is $1.8, and lot size, then contracts into, let's say lot size is 1000 euro, multiplied by 1.8, you get 180 or 1800. Okay, now this one, is it in euro, is it in dollars? Can you think of that? What currency it will be there? It will be dollar. Hope that is clear, because when we have euro, you apply the conversion rate, be strike price or premium, that will be in the other currency. That other currency here is dollars. Now, should I keep the premium amount in dollar or should I convert it to pounds? That answer directly I can't tell. I should tell from the point of view of which country he is from, which country we are thinking the problem from. If the person is US person, dollar is his currency, stop at that point. That is his cash flow today. At the beginning, the premium outflow. But what will happen on the what will happen if the person is from UK or from European? Then it's a foreign currency. This should be converted into euro by using the spot buy rate. Okay, and if it is an importer problem, then expiry also outflow, premium is also outflow. You are a holder, you pay premium. Call or put does not matter. You are a holder, you pay both. So you add both. Interest also you can add. If you're importer, if you're exporter, on expiry you'll receive money. Exporter will receive local currency. Exporter will receive money, but premium you pay, interest on your premium you pay. So for exporter, you have to calculate the net amount. So you can copy it down quickly, or you can take a screenshot and copy it later. This is regarding the call option. Call and put currency option hedging. Similarly, I'm going to do for the future as well. Okay. Okay, now currency futures. Again, first let me give a recap of the futures, not in detail, quicker recap. It's a future contract. Underlying asset is a foreign currency, local currency, foreign currency. What are the features of contract? Forward contract and future contract. Both are contract entered today, settlement at a later date at a fixed price. But what is the difference between future and forward? In the future, it's an instrument traded in the stock market. It has some standard features, not there in forwards, because that is over the counter product. What are the standard feature? Lot size. Margin money, like a deposit, you pay now, you'll get back later. Expiry date, standard expiry date, month end, and square off, net settlement basis. And we have mark to market settlement. You don't wait till the expiry. Amount will be created or debit from your account as a margin adjustment on a daily basis. So if it is future buy, you pay initial margin. You will have some lot size. You enter into some number of contracts. On exit, you square off by doing future sell. And profit is difference between futures and future buy, of course, multiplied by a number of contracts into lot size. And if you have margin money, if interested information is there, that is an opportunity cost that also will be subtracted. If you do future sell, you pay initial margin, lot size, number of contracts. On exit, you do future buy, short position, you remember, and square off. Profit will be future sell minus future buy minus interest on margin money. What is a special feature in currency future? If you are buying underlying asset, it means implied selling another currency. So if you are buying foreign currency, implied selling local currency, implied selling foreign currency, and buying local currency. Just like option, a call option is implied put option, and put is implied call option. Same thing applicable for currency futures. Okay, so how do we identify in currency future? What are the steps? Let's take a look at the steps. Focus on this one. This is important. What we had in option, replicate the process. Replicate the process. How? First step, identifying type of future. Same thing, quotation, 1 unit equal to so many units. Left hand side is the underlying asset. Or if they mention lot size, the lot size in the underlying asset. If you are buying underlying asset, think from underlying asset point of view. Same process. I'm not repeating examples. Same process. What I told in options will repeat. If I'm buying underlying asset, what I did in option, if I'm buying underlying asset, we'll do call option. Here, I will do future buy. If underlying asset is sold, there I do put option. Here, future sell. Simple. Then, second step, at inception. There we compute a number of contracts, right? Same thing. Number of contracts. Two situation possible. If the invoice amount is same, if the invoice amount is not same. If the invoice amount is same, invoice amount by lot size. If the invoice amount is different from lot size, currencies are different, underlying asset is different, invoice amount is different, no problem. Invoice amount divided by there what I did, I divided by strike price. Here I divided by future price, the future rate divided by lot size. When will I do this process? When invoice amount is in dollars, lot size in rupees, two different currencies. So to convert the invoice amount in dollar into rupees, what do? I divide by future price so that will be in dollar, lot size in dollars. You can get the number of contracts. And initial margin, how many ever contracts you have into the margin per contract. But let me tell you, initial margin is not your cost. It's a deposit. You make a deposit, it will come back to you later. But what is the cost? The opportunity cost, the cost of borrowing, interest on initial margin. That will be your expense. I'll show you how. Cash flow at expiry. Three types. Remember in future, easy to remember. What do you do in future? Arbitrage, I told you. SFM. In spot market, what do you do? In future market, what do you do? In money market, what do you do? Net position. In spot market, what do? You go to spot market and sell invoice amount into spot rate. Spot sell if it is for exporter, spot buy for importer. In forward market, in future market, you do square off. If you have done future buy earlier, now you do future sell. If you future sell earlier, now you do future buy. You do square off. Profit or loss will come. How do you get profit or loss? Future sell minus future buy. That's your profit into lot size into number of contracts. One extra step may come when, if this is a foreign currency, sir, when it will happen? If the lot size is, let's say, 10 lakh rupees, lot size rupees, and you multiply it by this future by future sell, you treat like an exchange rate. You treat like an exchange rate, conversion rate. So when lot size in rupees multiplied by the exchange rate, you get the answer in dollars. Dollars foreign currency. So then you will get one extra step, that is you will have to convert it to spot rate. If it is a profit, spot sell rate. If it is a loss, you have to compensate spot buy rate. So this situation will arise in this case. Whenever you apply this, invoice and lot size are different. In that case, this situation will arise. And in money market, interest on money, margin money, you are going to make a payment. So then you compute the net cash amount. If it is for exporter, in spot market, you receive. In future square off, you may receive, you may pay. Profit means you receive, loss means you pay. Money market, you always pay. If it's importer, spot market, you make a payment, outflow for importer. In square off, maybe inflow, maybe outflow. If it's a profit, inflow, loss means outflow. In money market, will always be outflow. So this is the currency future position. You can take down or you can take a screenshot and copy down later. If you have any doubts, you can get clarified. And one more point I forgot to tell. How do we know this spot rate on expiry? How do we know in advance? In options, you know strike price. In options, in futures, how do we know? What will happen on expiry? I enter into future buy, but at what rate I'll square off? That I don't know. This future problem is a post-mortem problem. What is post-mortem problem? Event have occurred. You have taken the future position already. And what will be the net effect? So it's a post-mortem commentary. By taking future, after the event have taken place, we are telling, oh, this is what happened. Had I not done, it would have happened like this. They'll tell you, compare currency future hedging versus unhedged position. Now, if it is unhedged position, only this you would have got it, right? Invoice into spot rate. This would have been unhedged position. Unhedged position. You would have got 10 lakh. By doing the whole process, you got 9,90,000. You tell, not hedging would have been beneficial. You are not telling in advance. You are not giving recommendation. You are analyzing. You are giving comment post-mortem. Unhedged position would have given you 10 lakh. Future, this transaction together, all the three put together, gave you 9,90,000. The unhedged position would have been beneficial. Or if unhedged position is only 8 lakh, then you tell, oh, future position became beneficial. It's a post-mortem commentary. This will not be known in advance. This will not be not known in advance. Not known in advance. But let me tell you, almost 2-3 attempts once a problem is asked on this area, and that too specifically where lot size is rupees. You go and check the previous question paper, you will see. Almost 2-3 attempts once for standard 8 marks question. Indian exporter, lot size is rupees, where exporter normally you think sell, but this underlying asset is rupees, you do future buy first. Repeated problem on this area. You can check the previous year question papers. Anyway, you can take the picture of this, or if you have any doubts, you can get clarified. Okay, so this is with respect to the hedging techniques. We started from forward cover, money market cover, netting, leading, lagging, interest, the supplier versus supplier versus bank rate, local borrowing versus foreign borrowing, letter of credit problems. Then we have currency option, currency futures. One more is there, that is the interest rate swap. That I'm not discussing now. Interest rate swap means exchanging. I mean, sorry, currency swap. You have taken a loan and you swap it with another loan. That portion we'll discuss it in the interest rate management. First, I'll discuss interest rate swap, then I'll do currency swap. That is also one of the areas for hedging purpose, where the cash flow is certain or to the extent is certain by doing these transactions. Okay, so hope you are clear. That is giving you an overview of hedging, a very essential, almost in every exam, one question is focused on this area. Foreign currency exposure hedging. Okay, so come to this problem now. Come to this problem. This problem will be on money market hedging. Hope you got the question. An exporter is a UK based company. Invoice amount 3,50,000. The credit period is 3 months. Exchange rate in London, spot rate dollar slash pounds 1.5865, 1.5905. 3-month forward rate dollar slash pounds 1.61, 1.614. Rates of interest in money market. Compare and show how money market hedge can be put in place. Compare the contrast outcome with the forward contract. So the problem is from exporter point of view for a UK based company. So it's for an exporter. I think here it can identify what is the left hand, what is the local currency, what is the foreign currency here. Now, when they say hedging, they should give you from whose point of view the problem is asked. Otherwise, how do we know which currency to buy, which currency to sell? So, when they talk about hedging, they must give the country of origin. So, it's a UK based company. So, local currency will be pounds. And foreign currency will be dollars, US dollars. So, problem is from a exporter point of view. So let's use the shortcut what we learned. Let's not do the whole process. What a shortcut we are going to do. This is for an exporter. We'll start with invoice amount. Okay. They asked for a forward contract. Okay, forward contract I'll do later. Let me just finish off the money market hedging part. Exporter. What is the amount? Invoice amount we start with. Into. Tell me, spot sell or spot buy? I mean, yeah, spot rate. This for an exporter. Exporter means what is his nature? Sell. Is going to be spot sell rate into 1 plus local in this case is pounds and divided by 1 plus foreign in this case is dollars. Okay, now which pounds deposit or borrowing? We are talking about an exporter. Exporter means what comes to your mind? An asset. Therefore, numerator, you make it as deposit. Denominator, you make it as borrowing. So first step will be here. Second step is spot sell. Third step is deposits. So step 1, you can write down in those steps. Present value of dollar borrowing. This first step I'm telling, present value of dollar borrowing. How much amount will be required of dollars? 3,50,000 divided by, remember, be very careful about the rate of interest you choose. Dollar borrowing, dollar loan, 9%. So 1 plus 0.09 for a period of uh, 3 months. See, it's not visible also. THRE, they could have given the number 3. They given THRE. Anyway, 3 by 12. How much does it come to? 3,42,298 dollars. 3,42,298. You can take decimals also, or you can ignore. Both are fine. Step 2. What you need to do? The step 2. You see, spot sell. Amount borrowed above. Spot sell. So dollar 3,42,298. Now please think from dollar point of view. What is the conversion rate we have? Spot rate. Don't look at forward rate. Look at the spot rate. Dollar slash pound. So 1 pound equals 1.5865, 1.5905 dollars. So which is left hand side currency here? Pound is left hand side currency. Dollar is right hand side currency. And what unit we have mentioned in the problem? I mean, just now in this step. 3,42,298 is in which currency? It is in dollar terms. So 3,42,298 dollar terms. That means right hand side, right? You see right hand side. Therefore, we should do divide. It's right hand side, so we should divide. Now, what we are doing now, don't think from pound point of view, stick to the dollars only. Dollars, what we are doing? We have written spot sell. Dollar is being sold, and sold at a what rate? Sold will be at a lower rate. Now, lower rate is how much? Sold at a lower rate is how much? But we are dividing. So when you divide, the lower rate is 1 divided by higher rate. That is 1 by 1.5905. Dollar given, right hand side, divide, selling at a lower rate. When you divide, the lower rate is 1 by higher rate. So you get 3,42,298 dollars into 1 by 1.5905 equals 2,15,214. This is in which currency? This will be in pounds. Because dollars was where conversion rate we apply, we get pounds. Step 3. What we do? We are having the pounds now. The pounds will be deposited. Deposit the pounds above. And matures at matures after 3 months at. And what is mature after 3 months is going to be the effective inflow for the exporter. Effective inflow for exporter, which is equal to 2,15,214 pounds what we had into 1 plus this is deposit for pounds. So pounds deposit rates is 5%. Pounds deposit rate 5%, 0.05 for a period of 3 months. Two lakh 17,904. So this is the amount under money market hedging. Okay, if you go under forward hedging, what would happen? Because they said they want to compare and contrast with forward hedging. Forward hedging, under that how much receipts? Effective inflow. For exporter. Okay, so you have to take the forward rate. Which rate would you take? 1.6100 or 1.6140? Forward rate. 1 pound equals 1.6100 hyphen 1.6140 dollars. What we have 3,50,000 is dollars, and dollar is right hand side, and right hand side means we have to divide. And what we are doing with respect to dollars, dollars we are selling, and selling at a lower rates, and lower rate means because we are dividing 1 divided by higher rate, 1 divided by higher rate. So what is going to be 1 by higher rate? That is 1 by 1.6140. In fact, if you think a little bit more logically, you get the answer faster. When you took spot rate in the money market hedging, what we have selected 5905, the second rate. Now in forward rate, second rate 6140, you get the answer. Okay, so $3,50,000 into 1 by 1.6140. This was dollars. So now you'll get pounds. 2,16,850. Pounds. So which is beneficial? Inflow for exporter, whichever is higher beneficial. So overall we can say, you can write down money market hedging is beneficial because there you're getting more, 2,17,000 you're getting, here 2,16,000 only. So money market hedging is beneficial for the exporter. Money market hedging is beneficial for the exporter. Hope you got it. Okay, very good. Okay, move on. Let's moving on to the next question now. Come to this problem. Come to this problem. Along with solving this problem, the concept or theory also can be understood here, and we will do analysis also afterwards. One typical question which is asked in exam. This Gibraltar problem. Gibraltar Limited. Are you able to get that one? Okay, let's read, and after reading it, I'll explain you the concept. Gibraltar Limited has imported 5,000 bottles of shampoo landed cost in Mumbai of $20 each. The company has the choice of paying the goods immediately or in 3 months' time. If this choice is given to Indian, why will we lose it? Tell me. If the amount is payable for goods immediately or in 3 months' time, it seems. Obviously, we'll pay after 3 months only. But let's see what are the consequences. It has a clean overdraft limited where 14% rate of interest is charged. Calculate which of the following method would cheaper to the Gibraltar Limited. Pay in 3 months' time with 10% and cover risk for forward 3 months. Settle now at current spot rate and pay interest of the overdraft for 3 months. The rates are given below. Mumbai, rupees/dollars, 3 month swap is also given. Options. Okay. So basically, what is this is all about? You make the payment today or you make the payment after 3 months. So what are the two things to be compared? If you make the payment today to supplier, which rate is applicable? Spot rate is applicable. And if you make the payment after 3 months, then forward rate is applicable. So one is for spot rate, other is forward rate. So we are comparing which cash flow is better. But when we are comparing two cash flows, you know the time value of money to be considered. So if you pay today, to make it comparable, payable after 3 months, what do we do to make it comparable? We do as if there is a borrowing. That's what they said. If you pay at current spot rate, you pay interest for 3 months so that you can compare. Hope you're able to understand what is happening. Let me do it along with you. So two alternatives are there. Alternative 1, you also read along with me. Alternative 1, alternative 2. Alternative 1 is pay after 3 months. Pay after 3 months. Pay supplier, you mean. Pay after 3 months. And alternative 2, pay immediately. Pay immediately. Means you are taking if you pay after 3 months, no problem. But if you want to pay immediately, where you get the money from? You have to take a loan from the bank. That's what they said. You pay interest on the overdraft for 3 months. So it's also like pay after 3 months. This is like using supplier credits. And this is after pay immediately. So you're using bank credit. So this problem is also kind of local borrowing versus foreign borrowing. But we don't do for any interest differential and all. We straight go for the actual cash flow method because some more interest and all is there. A lot of things are there. We don't want to confuse it. We'll go cash flow method. That's what institute also does. So if I use supplier credit, I pay after 3 months. If I want to pay supplier immediately, today I should take loan. So this is the two choices we have, two alternative we have. Let's first discuss applicable rates and then we'll come to the calculations. Okay, first we'll come to the applicable rates, then we'll come to cash flow calculations. Okay. Two rates to be kept in mind. One is which interest rate applies, and then which conversion rate, which exchange rate applies. Okay, let me take the simpler one. If you pay after 3 months, which rate applies? We just discussed we are going to apply forward rate. And if you pay immediately, which rate applies? Spot rate. Spot rate applies. Okay, now coming to interest rate. If you are paying after 3 months, is the supplier telling me, pay whatever amount you want now, don't pay after 3 months you pay. Is it interest free 3 months? What the supplier is telling? No, pay in 3 months with a 10% cover. With a 10% cover. That means what? You have to pay 10%. I mean 10%. Cover risk means that is forward cover. Sorry. 10%. You have to pay interest with 10%. And 10% means 10% per annum. Okay. I know you will be like, where they have given 10% per annum. That's my interpretation. If you think 10% is for 3 months, you can take it. What institute has taken? 10% per annum. But some inconsistencies there in the examination problem. Sometimes they take full 10%. Sometimes they take 10% per annum into 3 by 12. So that clarity is not there in the institute questions because prepared by different people. So whichever way seems fine for you, you make assumption clear, you write a note assumption and you solve accordingly. So I will interpret 10% for 6 months. So I'll match the institute answer now. So 10% for 6 months. So that's 3 months. 10% for 3 months into 3 by 12. But anyway, 10% is the rate of interest per annum for 3 months. Okay. Alternative 2 is you have to pay overdraft, and overdraft interest is 14% per annum for 3 months. Okay. So these are the applicable rates. Now let's come to the cash flow calculation. Cash flows. So we will do cash flows today, cash flows. Then any interest that you need to add, so the time value of money will be there. And result what we get will be today plus interest, and whatever we get is the cash flow after 3 months. And let's see, wherever the cash flow after 3 months is cheapest, we'll discuss that point of view. Okay, so today cash flow, if you pay after 3 months, so what will be today cash flow? Are you paying anything? In respect to alternative 1, you are not really making anything, but amount payable, if you want to calculate, I'll just write it here, but you don't make the payment, but for reference purpose, it is 5,000 bottles of 20 each, dollars each, 5,000 into 20. This is the amount which is liability exists, 5,000 into 20, which is $1 lakh. Today value. You don't make this cash flow today. You will pay interest at the rate of what? For 3 months. So $1 lakh into 10% into 3 by 12. How much you get? 1 lakh, $2,500. So total we will have $1,02,000. $1,02,500. But we have to convert it to rupee terms. And which rate are we going to consider? 3 months forward rate. For forward rate, they have not given directly swap points. And swap points are what? Descending order. Therefore, you do 35/25. Descending order means what? We need to subtract. Descending order. Descending order. So we had, that means the dollar is trading at a discount. We have to subtract. So forward rate equals 60.25, 60.55, minus 0.35, last to right to left, and minus 0.25. So 60, no, it's to get 59 points, 90 and 60.30, I think. So spot rate minus the swap points, we get the forward rate. Now, which one is the preferable? How much? Are we going to do 59.9 or are we going to do 60.3? That depends on, are we buying this dollars or are we selling this dollars? I mean, are we going to sell this? Now, we are thinking from an importer point of view. This kind of problem is always from an importer point of view. You can take it from me. Now, we have to make a payment of $1,02,500 to the supplier. We are supposed to pay 1 lakh along with interest of 2,500. We're supposed to pay $1,02,500 we need to be able to make the payment to the supplier. So we need to buy. And in fact, importer always go for buy, right? Importer means buy. So this need to be purchased. So purchase means at a higher rate, 60.3. To be purchased at a higher rate. So cash flow after 3 months, 61,80,750 rupees, 61,80,750. In fact, you can write the answer in one line also. 5,000 into 20 into 1 plus 0.10 into 3 by 0.10 into 3 by 12 into 60.3. You get the answer in one line, but transactions will not be explained if that is the case. So we write it separately. Okay. Alternative 2. If you pay immediately means what? You have to pay $1 lakh, right? 5,000 into 20, at $1 lakh will be paid immediately. And will be paid immediately means you have to use which rate? We have selected also spot rates. And spot rate 60.25, 60.55. Which one to be selected? Importer, to be able to make the payment to supplier, needs dollar which he has to purchase from the spot market. Importer, buy. Buy at a higher rate, 60.55. So multiplied by 60.55. $1 lakh into 60.55. You get rupees 60,55,000. Okay. Interest for 3 months on this amount, 60,55,000. At rate of interest different, 14% for 3 months. $2,11,925. $62,66,925. 62,66,925. Okay, so which one is cheaper? This 61,80,750, both are outflows, so this is cheaper. So we can just say that paying after 3 months is beneficial. Alternative 1, paying after 3 months is beneficial. Okay, hope you got it. Simple one. Before we go further, let me do a little bit of analysis on this one, just for our reference, for understanding purpose. Okay, why this became cheaper? So if you apply the concept of our IRPT part, if you have to apply that concept, what would happen? Let's do that. Okay, now what is happening in this problem? Either you are paying 10% interest or you are paying 14% interest. In both the cases, you are having interest. In the sense, either you are using supplier interest, the interest charged by the supplier, or you are using the rate of interest charged by your own bank overdraft. So this is a typical case of bank overdraft locally, means like a local borrowing. Using the rate of interest charged by the supplier is like a foreign borrowing because supplier is in foreign country. So this is a typical case of local borrowing versus foreign borrowing. This is local borrowing versus foreign borrowing. So here I would have discussed quite a few methods with you. Let me at least tell you the concept, a quick revision. If it is local borrowing, what is going to be your cash flows? Local interest rate. If it is foreign borrowing, what is going to be your cash flows? The foreign borrowing rate plus or minus premium or discount. Hope you remember. Plus for premium, minus for discount. So local interest rate is how much? In this example, overdraft rate is 14%. And foreign borrowing cost is how much? 10%. And minus premium in this case happened. How much premium amount? Premium, not premium, discount. Discount we are taking 60.3, right? This is applicable rate. Either we take 60.3 or we are taking 60.55. These are the two rates available, right, for us to do discount premium. So 60.3 minus 60.55, 55, okay. Buy rate, applicable for buy rate, offer rate, divided by 60.55 into 100. Okay, and this is for how much? This is for 3 months, I think. Yeah, so how much for 12 months? Into 12 by 3. You get minus 1.45% approximately. Subtract 1.45 discounts. You get 8.55. You see, the local interest versus foreign interest. Local interest is costlier, and this foreign borrowing is cheaper. So we selected like this. Or if you follow interest rate differential method, I hope you know that. Interest rate differential. Versus the premium or discount. In this case, we are having discount. Interest rate differential 14 minus 10, 4%. Premium or discount. In this case, we have premium minus 1.45. Okay, so when it is 4% and minus 1.45, if you are doing arbitrage, where you would have borrowed, where you would have invested. 4% is good for investment, and 1.45% is good for borrowing. And interest rate differential means this is applicable for local, and premium or discount is applicable for foreign. So you get this one. Interest rate differential. So which is preferable? The foreign borrowing was cheaper, so this is cheaper. Borrowing in foreign currency was cheaper. So this is what the option we recommended. And here also this is the option we recommended, and cash flow method also is the option we recommended. But which one would you recommend from exam point of view? If they ask you purely about borrowings, I mean, institute has solved mostly by cash flow method. They followed this method. Most of the answers. Local borrowing versus foreign borrowing problems. Supply credit versus bank credit problems. We are going to learn letter of credit, LOC credit problems. Everywhere they followed cash flow method. But this local borrowing, foreign borrowing differential or this premium method, they have applied in arbitrage problems. That's what they have given in the suggested answers. You can also follow the same method, but conceptually, all can be understood with this analysis. Okay, you want any clarification or anything? Interest rate differential, always take it for local. So if interest rate differential is high, local investment is good. If interest rate differential is less, local borrowing is good. Premium or discount, you apply for foreign. Easy to remember, interest rate differential is for local, premium is for foreign. If interest rate differential is less, that means local should be borrowing less. If interest premium is more, local should be investment. Opposite is for others. You get 1.4, 1.65, is it? Okay, 1.65 you get. Okay, I'll correct it. 1.65 you get. No problem. 1.65. 8.35. But usually what happens, this used to be premium. Usually in some problem, suppose in this problem, just imagine in this problem it was not trading at discount, it was trading at a premium of 6%. Just imagine, then what would have been your answer? If it would have been trading at a premium of 6%, so total would have been how much? Foreign borrowing cost of foreign borrowing 10 plus 6, it would have been 16%. Local interest would have been beneficial then. Similarly, if I go with interest rate differential is 4, premium is 6, local interest differential is less. So it is good for borrowing. Our option would have been pay the supplier immediately, use bank borrowing, not the foreign supplier rate of interest. Hope you got the question in different methods, the analysis part as well. Okay, let's go further.